To the Swedish telecom giant. We're going to keep an eye on how that shakes out as well. But then, Anna, you really hit it. That oil stock story, you were seeing Brent crude just shy of $75 a handle, a barrel, excuse me, down about 4%. Do we see a more magnified move in the FTSE 100 off the back of that move?
Yeah, absolutely. A substantial move in oil prices. So, yeah, as you say, down by more than 3.5%, down by $3 or so. So certainly focus in on any underperformance coming through in the London market as a result of that, or any weakness that we see in energy stocks more broadly. The FTSE 100 is the only one we have trading so far, and it is pretty flat, looking for a bit more upside in other markets perhaps. So the IBEX up by 0.3%, the Stock 600 as a whole then getting a price and up by 0.1%. So very modest gains coming through as perhaps we look to catch up a little bit with what happened in the United States, as we were just discussing in yesterday's session. But it was technology stocks that led us higher stateside. Some of the more reassuring words around NVIDIA and its Blackwell chips and whether it's able to deliver everything that customers want. It can't deliver everything that customers want. We know that. Really oversubscribed those orders. But certainly that's been part of the focus stateside, and we saw tech do really well yesterday. Here in Europe, then back to this moment, and the CAC 40 is down 0.1%. So continuing some of that weakness perhaps that we saw yesterday on that market, Critty, and the DAX up by 0.4%. What do you see if you dive a little deeper?
Well, it's just literally a tale of two very different sectors. That outperformance in tech that you were talking about, you said it, Anna. ASML, your biggest index contributor to the upside, perhaps taking its tone from that record move that you saw over in the States as well. You certainly saw that shakeout in Asia. So ASML is going to be up there alongside SAP, some of the other tech names that we see in this region. But the downside, the heavy hitters, are absolutely going to be in the commodity space, and that's where you're seeing the red on the screen this morning. Your biggest index drop or index weight is from Shell, Total, BP. You name your energy company in Europe, it is trading lower today off of that macro move.
And by some margin as well. So BP down by 3.7%, Total Energies down by more than 3%. So we're seeing substantial moves in some of these oil names on the back of this much weaker oil price, down by 3.8%, as we said, on the Brent price, 74.55. And Critty, worth reminding ourselves that this is a write-up, well, two things here. There's the OPEC revision to its expectations and what that tells us about the demand story, which I guess the market kind of knew. And then there's an unwind of some of the geopolitical premium that we're seeing here, perhaps, on the back of that Washington Post story that is sort of like a revisit of last week's meeting between Netanyahu and Biden and what they say was said by the Israelis about their commitments to not attack energy infrastructure.
And we just had this conversation with Mark Cudmore over on our Markets Live team as well, is that does this mean that there was this geopolitical premium baked into the price at the end of the day, or is this simply positioning? Is this a kind of shakeout around some of the options that we've seen in the energy sector and in oil as well? That's going to be something we factor into the equation, as well as how you position in these European markets broadly. We spoke to Julian Howard from GAM Investments yesterday about how Europe is permanently playing catch-up to the United States. Take a listen to what he had to say.
It's very hard to get excited about Europe, but it's quite easy to get excited about America. We have lots of European equity managers here who show you the chart of the discount, percentage discount MSCI Europe versus MSCI.
Yeah.
Isn't it cheap? But it never changes. It's a perma discount. You know, and you can't keep arguing that there's a discount unless you've got a really strong case for that discount window being closed. But it just never closes, really.
Let's get another perspective there. Bilal Hafiz, CEO and research head over at Macro Hive, joins us around the table. All right, so Julian Howard there called it a perma discount. When does a perma discount disappear?
I think, as its name suggests, I think it's going to be around for a while. I think the only hope for Europe would be if there's a strong cyclical upswing, and then the discount would reduce. But I don't think that's forthcoming. I think Europe has ongoing issues, but in particular right now, it's the fact that Germany is lagging the rest of Europe. And if Germany is the one that's lagging, that's a real problem for the European stock markets.
Is there a way to separate that, though? We talked about this earlier on the program with the guest in the bond space who was saying that basically the point that you just made, that if Germany's in recession, it takes the periphery down with it. But the periphery at the moment is almost cushioned by so much fiscal spend and outperformance and tourism revenue. Is there a lag to catch up to that German recessionary kind of spillover? Or is this an inevitable doom for all of Europe?
Well, it's a great point. I think for now, I think peripheral Europe could escape some of the weakness we're seeing in Germany, because as you said, some of the factors that are driving the strength in the peripheral Europe is things like tourism. There's certain catch-up consumer demand, which isn't necessarily linked to Germany. And moreover, Germany's weakness is specific to its own sectors that are doing poorly, in particular the auto sector, which is not related to what happens in Spain and Italy. So I do think the periphery could continue to outperform relative to Germany, at least for the next 3 to 6 months. So there could be this period where they don't catch down to Germany.
And picking up, running with this theme a little more, Bilal, about divergence within Europe, are we going to be having conversations soon about how one ECB rate doesn't work for everybody? Because that could be, if you can contrast what's happening between the German and the Spanish economies, they look so different.
Yeah, I mean, this will be, the continual story for Europe as a whole. And in the end, the way to deal with this is to have differential fiscal policy, which there is some scope for that. But this will be this ongoing challenge. And if you look at the wage data within Europe, it has been relatively robust. So although Germany needs interest rate cuts, the rest of Europe doesn't. And that's probably one of the reasons why the ECB may not necessarily cut as much as everyone thinks.
Okay, so if Europe's on a perma discount, are there opportunities, though, within that? Because, there must be some things that are being sold off because they are maybe caught up in a German basket and a bit of gloom around the German economy, but actually are much more to do with forward-looking investment trends and where you can make some money. So are there things in Germany or elsewhere in Europe, Bilal, that get you excited right now?
Yeah, I think elsewhere in Europe, I think one could look at that at a country level. So I think Spain and Italy, for example, are under-owned relative to, say, Germany. Moreover, there are kind of the tourism play that one could have. So there are sort of tourism-linked sectors that one could do. Within Germany, it's harder to find an obvious play because the industrial sector looms so large within Germany. Then outside of that, it's really the banking sector, which is the other play, which at the moment doesn't look that interesting, or it looks challenged at the moment to come up with a positive thesis for that.
Speaking of the banking sector, there are several fiscal policies that are kind of driving it. We talked about it today where the Dutch government is cutting down its stake in ABN AMRO. We've heard it in Commerzbank. We're talking about cross-border consolidation, but then also windfall taxes. How are you supposed to interpret the banking sector right now in the macro environment of lower interest rate cuts coming down the pipeline?
Yeah, I mean, I think the starting point would be where is net interest income going to be for all of these banks? So that's to do with the shape of the yield curve. As interest rates go down, in theory, you would expect that profits would go down. But US earnings so far show that hasn't been the case. JP Morgan's earnings last week showed that their net interest income actually went up. But in general, that's the first starting point. So in general, that's perhaps a negative story for Europe at the moment. The other side is all the cross-border purchases and so on. And I think one of the things we've seen in Europe for the last 10 years is that to do cross-border financial institution integrations is very, very hard because although it's supposed to be a European-wide market, in the end, when it comes to banks, it's a national market.
Bilal, Jamie Dimon seems to be a bit annoyed about all that focus on net interest income in the call with analysts. But, you can see where it comes from their point of view. They'd all expected that these profits would fall and then they didn't. And so they're sort of trying to understand, well, what do we not get about the way that the yield curve plays into your ability to make profits? So you can understand why he gets quizzed on it. It is a complicated business, though, is it? This relationship between where yields go, where the yield curve goes, and the bank's ability to make money on deposits and lending and all the things that add up to that net interest income.
Yes, absolutely. I mean, obviously, Jamie Dimon didn't like the fact that people focusing on this. He criticized analysts for wanting the numbers for their models. But in the end, this is how people assess the value of these banks. The challenge ultimately is what are the lags through which the different parts of the curve transmit to a bank. So have banks passed on higher interest rates to depositors? In many cases, they haven't. So in your bank account, you don't have high interest rates necessarily. And then on the other side, how many mortgages are people taking out, which banks can then earn higher interest on? So the challenge in the US market has been the mortgage market's been relatively weak. It's picked up recently somewhat. And then the deposit rate, banks haven't passed through high interest rates all the way through. So that complicates the picture in all of this.
But on the other side of that is, and this was, I think, the weak point in some of the JP Morgan and Wells Fargo earnings. If you look at credit card payments or even delinquencies, that's where you start to see the cracks show up, and that there have been late payments and there has been a slowdown in that usage. Speaking of cracks, though, is that kind of an anomaly, or are there more to come? Is that the canary in the coal mine?
Possibly. I mean, we have been seeing that for a while, though. For the last 6 to 12 months, we have seen all of those types of sort of late payment type measures picking up. And that does tell you that the lower income sector of the US economy is suffering right now. So high interest rates have affected them all. But the broader economy is actually doing okay. So what that tells you is that it may not necessarily be a canary in the coal mine, in the sense that if you see ongoing weakness in this part of the economy, it doesn't necessarily transmit to the broader economy, especially in the context of the Fed cutting interest rates now. So there'll be much less pressure coming from interest rates going forward.
Bilal, we get excited about the bank earnings story because of, the sector, but also what it tells us about the consumer, as just discussed. We get excited about the tech earnings story a lot, increasingly, it seems, with what's going on with NVIDIA and its ability to sort of keep ahead of the competition and to make incredible profits whilst doing that. What are you watching out for when it comes to this tech story now and the AI narrative? Is this something you're still investing around, or does everything just look too expensive?
Well, it certainly does look too expensive, but the stocks are doing well, so that tells you something. I mean, the good news is the valuations of these companies, these tech companies, are much better than, say, during the dot-com period. During the dot-com period, there was really a question of no earnings, poor cash flows, whereas today the companies which have high valuations, at least they have some cash flows. The difficulty we have is at what point do companies think that we need to scale back our AI investment because we need to see use cases? And that's been this ongoing debate for the last 3 to 6 months about the hype versus delivery of use cases. But so far, at least, it seems like companies are still focusing on this. We're a bit cautious about this whole story because we do think that companies will want to see some use cases have an impact on their bottom line. But at least price action seems to suggest markets don't care so much.
We're about 21 days away from the U.S. election. What's the Trump trade?
It's a good question. I mean, I think the biggest Trump trade from a macro perspective is higher inflation, because Trump, if he was to come into power, would introduce higher tariffs. He'd basically expel a large number of undocumented workers or even documented workers out of the US, which would have an impact on the labor supply, and he'd introduce tax cuts. So all of this, however you slice and dice it, this is inflationary. So I think an inflation trade of some kind, which would be higher long-term interest rates in the US, the possibility of Fed scaling back significantly its easings, I think that would be the big Trump trade.
Okay, Bilal, thank you very much. Thanks for joining us. Bilal Hafiz, CEO of Research and Research Head at Macro Hive, of course. Let's get quickly to the core six and have a look at how those individual stocks are performing in the midst of a market that is broadly higher, up by 0.3%, but with some notable underperformance coming through from London. We have weakness in energy stocks, more from Joe, no doubt, on that in just a moment. The CAC 40's also underperforming, maybe the luxury names in there. With all of that, yes, you can see LVMH is down by 0.5%, so that speaks to that underperformance over in Paris. Elsewhere, we see standout performance from the tech sector. ASML up by just over 1%, so we keep our focus on tech, just as we did in the US session of yesterday. Let's get a check on individual stocks then, and some of the sectors on the move. Joe has a briefing. Joe.
So this is oil stocks where we're seeing the main weakness at the open of trading today, particularly in the UK. BP, one of the worst, driving some underperformance in the FTSE 100. Also Total Energies, Repsol and Eni as well. Remember, these stocks are already down sharply over the past month or so, and this year having a rough year. But that drop in the Brent crude price today is weighing on this sector once again. So really a weak part of the market. But one part of the market that is benefiting is the airline stocks. These are some of the best performers today. given the potential reduction in fuel costs that this would mean. So we're seeing the likes of EasyJet, Air France, IAG and Lufthansa all gaining today. Bear in mind these UK names, EasyJet and IAG, already up really sharply. The British Airways owner up 40% this year already on a rebound in some of their passenger numbers, but that is a clear beneficiary of this declining oil price today. Then in terms of earnings, we got Ericsson, finally a bit of positivity on that one. We're up 10%. They're talking about a rebound in some of their infrastructure and also over in the US in particular, given that deal with AT&T really benefiting the company at the moment. We can see that feeding through as well into Nokia, the big rival, that one gaining it around at 1.8%. And down back in the UK, Wise, TransferWise, reporting a big increase in money being transferred across borders. So that one looking pretty strong as well. Then staying in the UK, in terms of your morning calls, I was very excited about NatWest, who I've been banking with for the past 20 years or so. They've got an upgrade to buy over at Jefferies, which does mean they no longer have a single sell. That's all due to the structural hedge, the rates benefits at the company. And then in terms of hedge funds, this one going the other way. Man Group downgraded at Exane, which says that the hedge fund listed in the UK has seen a bit of a drop in some of its performances and some of its fees. So that one coming down pretty significantly, down 3.6%. And then according to Citi, we're not buying enough takeaway food at the moment, and they are downgrading Delivery Hero for this reason, saying they've seen a drop in web traffic for Delivery Hero, and that one is falling at 2% over in Germany this morning.
Joe, thank you. Joe Easton from our equities team. Let's just quickly hit another piece of news, Critty, and this is around UBS. Now, it doesn't strike me as all that surprising that when you're a business the size of UBS and you take on a business the size of Credit Suisse, that maybe you need to look at your resolution plan. So what happens in the event of any kind of crisis here? And it does seem as if the regulator is minded to make that happen. So UBS is going to be asked to revise its recovery and emergency plans as a result of having taken on integrated Credit Suisse. It seems there's more work to do, all this to do with the too big to fail rules around the banking sector.
Yeah, and in the process, suspended the annual approval of the recovery and emergency plans, as you were pointing out. The shares down about 1.5% in trading. Unclear at the moment of whether or not that's a cyclical trade or whether that's an actual response to this move. But UBS shares under pressure.
Coming up on the programme, we will get back to what's going on in the auto space. We've had a lot of coverage of that sector recently, and a lot of it coming together at the Paris Auto Show. Why German car makers are getting left in the dust by Chinese EV makers in their biggest and most lucrative market. We'll pick up on that theme in the context of all we've heard from Paris at that auto show. We'll bring in Oliver Crook shortly to the conversation. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We need to find a deal with China, okay? And we need to get used to a form of co-petition, or that means basically on the one side you compete, on the other side you cooperate, as actually they did with us when we went 25 years ago in China to take also advantage of the Chinese market.
That's the Renault CEO, Luca De Meo, speaking to Bloomberg at the Paris Auto Show. Car makers have indicated that demand for electric vehicles is picking up as prices come down. Bloomberg's Oliver Crook has been in Paris. He was at the auto show. He's moved on now, but he's still thinking about what this means for the auto sector and thinking forward to regulation around the auto sector. Oliver, good morning. So amid all of the tensions over tariffs, what did you learn then about how Chinese brands are approaching the European market?
Yeah, listen, despite the fact that you sort of have the result of what happened here in Brussels, in Paris there at the auto show, is about this sort of legislation and these sort of tariffs going on the Chinese automakers, basically they're not slowing down at all in terms of their sort of desire to get involved into the European market. And really what they're focused on now is not being sort of just categorized as just another Chinese brand. They really want to make distinctions between sort of each of the identities of these brands and really get in front of these European consumers. What I think is very interesting is how they're approaching basically that process. We still don't have the final tariffs. There is still some room for negotiations, though it seems unlikely that they will be materially different. What I think is very interesting is Stellantis, for example, has a joint venture now with the Chinese automaker for their production within Europe. They own 41% of that. And what's interesting about that is that they're sort of inverting the German model that we saw from the 1980s, where these German automakers came into the Chinese market, had joint ventures, started producing cars there, and really sort of ramping up the volumes. One of the big differences that we should bear in mind, though, is that back then in China, you didn't really have an automotive industry, whereas in Europe, you certainly do. And that is really at the heart of the debate that we're having here in Europe, from Paris all the way here back to Brussels.
Give us a little bit more good news, perhaps, Ollie. When we're talking about EVs, it tends to be a lot of doom and gloom. Is there any reason for optimism?
So listen, we're starting to see a little bit of a pickup in demand, according to a lot of the executives that we spoke to at the auto show. That is in part because they've been able to sort of reduce the pricing really substantially from a year or 2 years ago. But I think what was interesting is that this was really an EV auto show for a sort of market that doesn't really want EVs right now. And that's a real problem for the automakers for a number of reasons, not least of which you have new regulations, again, coming here from Brussels that kick in next year, where they basically need to sell a fifth of their cars. About 20% of their fleet needs to be EVs in order to avoid huge fines. We're talking about billions of euros worth of fines. And if the sort of policymakers here in Brussels do not want to adjust their targets, how do you adjust what the market wants? And that is exactly what we asked Carlos Tavares, the CEO of Stellantis, about how to sort of manage that transition with those big regulations coming in next year. Have a listen.
Right now, we only ask two things to the governments, and specifically the European governments. We ask stability of the rules. We do not ask for any kind of postponement, because we are ethically committed to contribute to fixing the global warming. So we don't ask for any postponement. We ask for stability from one side. And from the other side, we ask the governments to stimulate the demand, which is not to help Stellantis, but to help the consumer, so that the consumer can buy EVs at an affordable price.
So a call there from Carlos Tavares to really stimulate the demand side of this. And the consequence of not doing that, guys, is going to be substantial, both from Luca De Meo and Carlos Tavares, that basically that the number of factories that are currently operating in Europe may not be sustainable without that demand coming back.
We've seen different opinions in Europe about these tariffs then, Oliver, and part of that's been to do with the exposure these car companies have to China. Meanwhile, in China, a lot of the German car makers losing some ground.
Yeah, so listen, we had the third quarter numbers just a couple of days ago, and we just saw absolute brutal numbers from across the board from the German automakers. Mercedes down 13% in China, Porsche down 19%, BMW down 30%. There are two concerns here. There is one, the sort of domestic Chinese story about demand just not being there in general and the sort of stimulus coming into the economy. But I think an even bigger question there is, Anna, is once that demand comes back, will that demand be different from what it was before? Will that demand be for those German automakers? The reality of the situation is that more than 50% of new cars sold in China right now are EVs, and the Germans are just flatly behind.
All right, Bloomberg's Oliver Crook joining us out of Brussels after his stint in Paris. We thank you so much for that crucial context. Let's talk about the other side of the movement this morning. That, of course, comes in oil prices tumbling after the Washington Post reported that Israeli Prime Minister Benjamin Netanyahu told the White House he's willing to strike Iran's military rather than oil or nuclear facilities. We're now joined by Bloomberg's senior executive editor for energy and commodities, Will Kennedy, joining us around the table. Will, how much of the move that we're seeing in oil prices was actually a geopolitical premium baked into the price?
A fair bit, I think. It was clearly it touched $80 at the start of last week, the highest we'd seen in several months, and that was driven by the speculation that came after President Biden addressed it in public comments, that they would target oil infrastructure, and that has huge risks for the oil market in terms of limiting exports from Iran, and ultimately if things escalated to the wider Persian Gulf. So any indication that's not going to happen will reduce the risk premium that we see in the market. At one point today, we were down more than $3 a barrel, back down to almost 74. That's $6 off where we were at the start of last week.
Right, so that's a substantial move. We see that playing out in oil markets, as you say, and then reading across into equity markets and beyond, Will. What about the other side of this, which is not the supply side, but on demand? We've seen OPEC come through with revised expectations for what demand will look like. I think they're on the high side of expectations, even after they've cut them. But this is the sort of direction of travel, is it, despite what China is doing?
Yes, that's right. I think that underneath this geopolitical tension, the market has actually been following China very carefully and the discussions, and we've seen about stimulus and how that's played out in other markets around the world. And I do think that in common with some other markets, there is a degree of disappointment about some aspects of the stimulus policy from China, and a great deal of concern about just how strong Chinese demand will be. It's looking pretty flat this year, which is unusual. It has traditionally been the biggest driver of global oil demand. And on top of the weakness you see in the China economy, you've also got their move towards electric vehicles, which is the biggest anywhere in the world. So you put all that together with OPEC plans to increase supply going into 2025, and there is a lot of concern among traders that the market doesn't look very tight next year, that it looks a little bit loose, and that is the background playing underneath this nearer-term tension about geopolitics.
30 seconds, I'm going to put you on the spot. We're 21 days away from the election. Does the election trade have any impact on oil?
Yes, I think people will see that. Yes, it does. It's hard to read. I mean, one aspect is that some people would tell you that Trump would be good for oil production in the US. I think that not everyone agrees with that point of view. On the other hand, Trump is likely to be much more hawkish on Iran, perhaps clamp down on Iranian exports, which could crimp supply. So it can go both ways. Maybe it's a wash at the end of the day, but it will matter if Trump wins the election to the oil market for sure.
Sounds like volatility is what we're in for. Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy, joining us around the table. Coming up on the program, taking a little bit of a pivot, getting a frontline view on the U.S. antitrust crackdown from the Justice Department's Hetal Doshi. An exclusive interview coming up next. Stick with us. This is Bloomberg.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Antitrust scrutiny remains an overhang in the tech sector. Take Google, for one example, embroiled in two separate antitrust trials brought by the U.S. Department of Justice, alleging that the tech leader illegally dominates online search and the roughly $675 billion digital advertising market. All while the company has beaten back European antitrust interventions, paying about, get this, 6.5 billion euros. U.S. enforcers still considering asking a federal judge to force Google to sell off parts of its business in what would be a historic breakup. We asked the Google CEO, Sundar Pichai, the Alphabet CEO, I should say, about the case. Take a listen to what he had to say last month, reflecting on the antitrust trial in Virginia.
That case is just getting underway, so I expect it to take some time. And but look, where we can figure out constructive solutions, I think we will. Where we think it really harms our ability to innovate on behalf of our users, or we are going to be vigorous in defending ourselves, and it's going to take time for it to play out.
The Alphabet CEO, Sundar Pichai, talking about the threat to innovation. Let's bring in another voice from the other side of the coin. Hetal Doshi, the top antitrust litigator at the U.S. Department of Justice, graces our set with her presence. We thank you so much for joining the program. Look, this is something we talk about a lot, especially in Europe, about whether this kind of scrutiny, at the end of the day, disincentivizes innovation at a time when Europe really needs it. It's the argument that's happening in Silicon Valley right now in terms of D.C.'s approach. What do you say to that, the threat to innovation?
Thanks so much for having me here, and that's a great question. I, as you might imagine, am not going to comment on any pending litigation against any specific company, and we always, have the opportunity to speak through our filings in federal courts across America, and so we do so. Zooming out, though, a little bit to the broader question related to the tension between, or perceived tension between enforcement activity in the antitrust front versus innovation and entrepreneurship, I think that history has shown us that the considered judgment of regulatory bodies and legislative bodies across the world has really been that competition fuels entrepreneurship and innovation in a way unlike anything else. And that's why competition, rather than consolidation or concentration of power, is prized in both regulatory and enforcement schemes across the world. The really important thing also with respect to that question, it's important to note here, is that I think that there is often a misapprehension or misunderstanding about whether antitrust enforcement in particular chills, for example, deal activity or things like that. And, I don't have the fiscal year for 2024 just ended, so I don't necessarily have that data in front of me today. But I do know that from the end of 2023, the fiscal year end 2023, that the deal volume stayed remarkably consistent. And so in HSR filings across America that have come to the Department of Justice or the FTC, we're talking about 1,800-ish reportable deals, and 24% of those are deals valued at above $1 billion. And so the idea that deal activity has been chilled is really inconsistent with the data. And so what you will see is that enforcement activity is important, and it is obviously getting a lot of attention and due scrutiny, but that doesn't mean that innovation or entrepreneurship is in any way quashed. It's quite the opposite.
Talk to us then about kind of this moment that it feels like antitrust is having. I mean, we've talked about this going back to the late 90s in terms of Microsoft and the antitrust case there. And from a Wall Street perspective, it hasn't moved the dial because 25 years ago, it didn't move the dial. But this resurgence, this bipartisan resurgence of antitrust when it comes to tackling big tech, it feels like it's having a particular moment right now. Why do you think that's the case? Why do you think the conditions for success may be emerging now?
Well, so I think I have to quibble a little bit with the premise of the question, which is to say that, 25 years ago that there wasn't a value or an impact of enforcement activity. This Justice Department that's bringing or, looking at antitrust enforcement in this modern moment is the same Justice Department that, took on Standard Oil, AT&T, and then Microsoft. And I think that, zooming out, again, not talking about any specific case, I think that the technological inflection that we face today and that allowed for innovation and entrepreneurship over the last 25 years is a result of, a byproduct of antitrust enforcement activity with respect to Microsoft, not in spite of. And so I think that it is important to note that these kinds of things are cyclical. There's a confluence to a lot of what's happening in the modern American economy. But the idea that antitrust enforcement is somehow a hindrance to that is frankly belied by the facts.
Okay, Hetal, you set that out very, very clearly. Just picking up on that theme and running with it a little more, I mean, these markets are not, well, to some extent, tech markets are regional rather than global, but there is a global component to this. And some in the big tech space would argue, don't clip our wings when we're trying to stand up to global competition. Is that an argument that that needs airing at all, do you think?
I mean, I think every argument is heard, certainly, by enforcers in terms of making considered judgments about which enforcement activities to engage in. I think, though, that the idea that the answer to consolidation or concentration is more consolidation and concentration is something that has been disproven empirically and across a variety of industries. And so I know that your question was animated specifically about the tech industry, but something that I see in my job on a day-to-day basis in federal courts across America is enforcement activity across a variety of sectors. And at various points in history, all of those sectors have made that argument, and we don't see that benefiting the American people.
Okay, well, I mean, on tech, you could argue that maybe it is just an American story and they're in quite different spaces compared to China, for example, where tech universes are quite separate. But in other industries, you could argue that, this is a global competitive race and US businesses, whether that's one at the top of the tree or a number competing to be at the top of the tree, want to take on China. I mean, that must be something that you take seriously.
Well, I mean, I think that geopolitical considerations are like any other consideration. There's a separate process at the Justice Department in terms of taking into account those types of ideas and considerations. But if you think about the factors qua competition, right, and you think about, from a global perspective, supply chain issues, choke points, and things like that, those are important considerations across a variety of industries, transnational or otherwise, and those are things that we look at. But that doesn't mean that's often not an argument in favor of concentration and consolidation. It's quite the opposite.
It kind of comes down to the very conversation we have around the Federal Reserve at the moment, which is how are they thinking about inflation? Outline for us, or connect the dots for what you do versus how it shows up for the consumer, for the American consumer.
Right. So I think that one of the interesting things about antitrust enforcement in this modern era is that it is very consumer-focused in a way that focuses on the necessities of life, not just high-technology products or things like that, things that affect people's bottom lines. And so one of the great things about the position that I'm in is that I have the opportunity to hear from people all across America where they're talking about kitchen table type issues, right? Like, what is what are the issues that are facing farmers? How does that appear in agriculture? And interestingly, from a totally different side of the equation, how are labor issues presenting in antitrust enforcement and in questions about consolidation? And so you will see arguments related to monopsony or labor, like the buy side of that equation with respect to consolidation in merger activity and in questions around merger activity to say, if you remove one more player from this market, what does that do on the buy side of the equation in terms of the ability of workers to have the best option to receive the most compensation for their hard work? And that is something that's unique to this particular moment and that resonates with the American people, certainly.
Yeah, certainly the non-compete arguments are a key factor right now in the United States. Hedl, don't go anywhere. We're going to bring you some sound from Margaret Vestager, of course, who heads up the antitrust efforts for the EU Commission. She commented on the similar dynamic that you're talking about. Take a listen to what she had to say.
You need to, of course, own your victories, but you also own your defeats. And we've had both. And hopefully that shows that we're willing to push the envelopes, also sometimes to take a risk in order to try to make sure that the market serves the consumer and that we are not just small pawns or meat for the machine.
So Margaret Vestager there speaking in Brussels off of her own wins against cases on Google and Apple, which brings me to, I think, a key point here in London, which is antitrust scrutiny has been kind of an area of wins for a lot of the regulatory authorities here. I'm curious from your perspective what that collaboration looks like between the DOJ and the folks over here in Europe. There is an argument here that Europe is leading some of that regulatory scrutiny. How do you view that?
Well, I think it's important to take a step back and note that our regulatory or our regimes are different in the sense that the European efforts are regulatory in nature, whereas what we do is enforcement in nature. And so we take the statutes that Congress gave us, dating back to as early as 1890 in the early 1900s, and say, how do the facts and circumstances that present in the markets that we're looking at today align with those statutes? And so I think that what's really important to note about the United States versus other parts of the world in antitrust enforcement or antitrust regulation is what an incredible moment it is for partnership, viewing the ideas of transnational impacts of a lot of this consolidation and concentration. And so that can present in a variety of ways in our criminal prosecution efforts. That certainly means that non-U.S. companies that engage in hardcore antitrust cartel behavior could be brought and held to account in the American courts. But it also means things like in advance of the 2026 FIFA World Cup, for example, that we're partnering closely with our Canadian and Mexican counterparts to ensure that collusive activity is rooted out early and dealt with in a prompt manner.
What does that look like in terms of that enforcement that you were talking about, though? What seems to be the right enforcement mechanism? Penalties, fines, an actual breakup? Is there one that seems to be a more effective mechanism than the other?
Unfortunately, the answer is it's very, very fact-specific, right? And so what you will see in most of our litigations as well is that if and when we get to the stage where a remedy is appropriate, we take discovery on them. There's facts and circumstances that guide that. And so it is really a bespoke solution to the problem at hand.
Can I ask you about where this activity takes place then, Hedl? I'm thinking here, colleagues are telling me that a lot of prior administrations settled a lot of this type of activity before it ever went to court, but now we're seeing more of these cases go to court. Is that something you're happy with? Is that something that's been a sort of conscious decision?
Well, look, as a litigator, it will probably surprise you to hear me say this, but it's not always necessarily the best circumstance that all disputes end up in court. But that being said, as enforcers, we shouldn't be scared to go to court when the facts and circumstances warranted, and there's an important principle that requires vindication. And so, yes, it is true that we are seeing multifaceted issues related to competition and antitrust across the American market in particular, and so that's reflected in the fact that we have a number of enforcement actions pending across a variety of those industries. But that's not to say that that means that we're always looking for a fight in terms of litigation. It just means that there are important principles to vindicate, and we as enforcers and career public servants are leading this fight shouldn't back down from that fight.
Hedl, thank you very much. Thank you for joining us. Hedl
Doshi,
the Deputy Assistant Attorney General for the Antitrust Division of the US DOJ. Coming up on the programme, we are going to return to one of the themes of the week, and that is the banking sector. UBS shares under pressure. On news, it must revise emergency plans as a result of its Credit Suisse takeover. We will dive deeper into what you need to know on that story. This is Bloomberg.
make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All of the discussion today has not actually been about tax. It's been about planning. It's been about the regulatory environment. It's been about getting infrastructure moving much more quickly and the sort of apparatus of government working to that common end. That's the real discussion that's going on here. That's the real focus. And actually, contrary to perhaps what people might think, tax is not the first thing that businesses and investors are raising with me. First thing they're raising with me is it really your number one mission? Is it going to be stable and strategic and for the long term, to which the answer is yes? And are you prepared to do the tough things on execution and the deliverables, which is about the length of time it takes from investment decision to actually seeing a project materialise? That's where I think we've been able to do a lot of reassurance that, yes, we understand that, and we're determined to do the follow-through on growth that is desperately needed for investors, for our country, and for the jobs of the future.
But forgive me, Prime Minister, but I think a lot of people, they may not be talking about it to you, but a lot of people are worried in this sort of vacuum that we've had, quite a long wait for the budget. There's quite a lot of what might be just crazy speculation around where capital gains tax might go, for example. So something like a 39% rate. Can you reassure people that whatever the change is, it won't be anything that significant?
Well, quite a lot of speculation is getting pretty wide of the mark, but...
So you say that 39 is wide of the mark?
Yeah, it's getting to the area which is wide of the mark. But I'm not going to fuel the speculation, because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought-through budget.
That was the UK Prime Minister Keir Starmer speaking exclusively to Bloomberg at the International Investment Summit in London, and talking about tax there and having to bat back lots of questions about tax, obviously, Chrissy, because we've had to wait a long time until the budget, and there's been a lot of people suggesting what might be taxed increasingly to fill this so-called black hole in the UK finances. The other side of that is where they borrow money from, and interesting to note some of the research we've had out on gilts recently, because we had Citi out with a note not long ago talking about, well, is there the potential for a buyer's strike? A lot of nervousness around UK gilts as we run up to a budget, a fiscal event. the echoes of Liz, the noise of Liz Truss in the background from a couple of years ago, even though no direct comparison at all, that is still very much in our lived experience and in our memories around the gilt markets. So interesting that Goldman's out with a note today, or in the last 24 hours at least, saying that they think that whatever is in the budget is going to be fairly gilt-friendly, which I think is an interesting one.
Yeah, it is an interesting one. And then it feeds into this idea of how does that show up in how banks are preparing for that kind of volatility as well. If we do have that lived memory, to your point of Liz Truss, that are all the banks around the world prepared for some sort of volatility, for some sort of shakeup in bonds, not just in the UK, but throughout the US election as well. And it kind of feels like that might be the focus this morning over in Switzerland.
Okay, yeah, let's talk about Switzerland and some of the regulatory measures there. Shares in UBS are in the red, although other financial services names also a little weaker this morning. But we have had this interesting new guidance out from FINMA. The financial supervisor is requiring the bank to revise its emergency planning plans as a result of its Credit Suisse takeover. Here with more is Bloomberg's Bastian Benrath-Wright. Bastian, give us an update here because, we've had a really big bank taking on another really big bank. So it might not surprise people that requires some rethink of what you do if this business had to be wound up. What are we learning here?
We're learning that UBS has a lot of work to do in incorporating the Credit Suisse business, and especially just on a technical level, bringing IT systems up to speed, making sure everything works together. And it said, the regulator said, as long as you haven't finished this business, we cannot sign off on your resolution plan. And this is basically what happened. As you said, it was kind of to be expected. But obviously it's you don't want to read those news if you're at UBS that the regulator says, hey, you have work to do there. They also said that UBS has to calculate more conservatively how much liquidity it can raise in the time of a crisis, if a crisis should happen again. Because there was obviously a problem in the Credit Suisse crisis that liquidity outflows were much larger than anyone had expected before. And the Swiss regulators want to be prepared here, obviously, and says, tell UBS now, hey, you need to plan very comprehensively and need to plan very conservatively how much liquidity you're actually able to raise if it comes to a crisis again.
Bastian, are there any more hurdles on the regulatory front from UBS and Credit Suisse? We know that after this merger, FINMA has come with mixed results to how that new entity is meant to operate. We've had that conversation on this very show with the former FINMA regulator, Urban Anghern. But what are the next steps here?
So basically, in general, this process takes a while in Switzerland because a lot of involved parties are going to be heard. The next step, which we are seeing, is the result of a parliamentary probe, which is fairly seldom that this happens, but the Swiss parliament has said we want to look at that. Lawmakers have said we want to investigate, especially if all the authorities involved acted correctly. And the results of this probe are expected about in December, early December probably. And then the process will go on, and there will decisions be made by how many reforms which the Swiss government has proposed earlier this year, which could see particularly higher capital requirements, increases in regulatory capital requirements for UBS of around 20 million. And we will see what of that will actually be implemented. That is kind of an open question right now, and a discussion which is going on, and we will see more clearly only next year. This will definitely take until then.
Bloomberg's Bastian Benrath-Wright joining us out of Zurich this morning to talk about that relationship between FINMA and UBS. We thank you so much. Let's stick with the banking sector and switch over to the States. Citigroup, Goldman Sachs, Bank of America, all reporting earnings today, likely to flag rising revenue pressures as the Wall Street giants start to reckon with those Fed rate cuts. Let's bring Charlie Wells joining us, patiently waiting on set, to talk about what we can expect. Are we going to see the same outperformance there that we saw in JP Morgan and Wells Fargo on Friday?
No pressure on these banks, but they have some tough acts to follow. I think it's never fun to follow JP Morgan. You know, they beat on net interest income, which was unexpected. They beat on investment banking revenue. Wells Fargo beat on investment banking revenue. And I think that's going to be the hope across these big banks as they come into this huge earnings day. But let's not forget, they're doing so in a macro backdrop that's actually pretty favorable to them, right? The U.S. economy is strong. The consumer is showing relative signs of resilience. And, you know, the Fed cut only a couple weeks ago, so it kind of remains to be seen how much of that cut trickles down into these earnings reports.
Yes, absolutely, and that was one of the key takeaways, wasn't it, from JP Morgan, much talked about. So what are we expecting then from the top three that are out today? Goldman, B of A, Citi.
Striking, you know, when you rewind back to conference season a month ago, you got a lot of kind of attempts to kind of temper the outlook from these executives. So David Solomon at Goldman was talking about how trading might not be so hot this quarter, potentially on course to be down 10%. That was striking. You look at Brian Moynihan at Bank of America. He was talking in a different light about investment banking, about how the transaction mix for that bank just hadn't been right in this quarter. And then interestingly, and I think we've been talking a lot about the consumer, Mark Mason at Citigroup talking about a shift in consumption on card at Citi. And so seeing consumers move from kind of discretionary spending on card to necessities. And I think that could indicate some strain, which would differ from what we've seen at some of these banks.
When we're talking about what we saw in some of these banks, it's a lot of green on the screen, good trading numbers, good investment banking numbers despite kind of dead capital markets activity. The credit card payments weren't so hot, though. The delinquencies started to tick higher. How much of that do we see as kind of the canary in the coal mine for some of these other banks?
That's what I think we really want to kind of square the circle on here, right? Because we're kind of getting mixed signals from the labor market. We're getting mixed signals from consumer sentiment. And I really want to see, you know, how does card perform at Citigroup versus, you know, a number of other banks? And also, you know, the sentiment that, you know, even within banks, it almost seemed like Jamie Dimon was in sort of a dour mood on Friday, whereas his CFO, Jeremy Barnum, was in a much more upbeat tone. And I think across the board, you did hear a little bit more upbeat sentiment coming out of JP Morgan and from Wells on the consumer. That's something to really hone in on today when management starts talking in those analyst calls.
Thank you very much, Charlie. Thanks for the update. Bloomberg's Charlie Wells setting you up for the bank earnings that we're going to hear about later on today. Other things we will get today, 10 a.m. UK time, German Economic Sentiment Survey, that will be released. Euro area industrial production also due. We'll have some data out of the US on the manufacturing side. On US politics, though, Chrissy, crucial point of the day to tune in. Bloomberg's John Micklethwaite, our editor-in-chief, will be interviewing Donald Trump. So plenty to talk about there. I mean, interesting that yesterday, when he was on the campaign trail in Pennsylvania, Trump was talking about deregulation of energy markets and home construction. So some top-of-mind economic themes from his perspective that might get a mention later on.
This is where we had that conversation with Will Kennedy earlier on the show. What is the Trump trade when it comes to oil? Because, of course, he's going to be aligning with a lot of the southern states and the GOP kind of take on fracking and oil access, which we know Biden has been more hesitant on. But we also know that the flip side of that is Kamala Harris's approach to fracking is that she doesn't want to ban it. She's actually diverging from Biden's policy in this area to really attract some of those independent voters where jobs, energy security are top of mind for that.
And of course, I'm sure the conversation will go global as well and think about what Trump's policies would be if we saw Trump 2.0 as a presidency, what his policies for the rest of the world would be. And with that in mind, Will Kennedy mentioned policy toward Iran, and that puts the Middle East firmly in focus. So no doubt, a really interesting conversation coming up later in programming. That is 5 p.m. at UK time. Bloomberg's John Micklethwaite interviewing former President Donald Trump. That is it for the opening trade. A mixed picture across European markets. Overall, stocks going higher as we are almost an hour into trade. Underperformance, though, in London and in Paris. That is it for the opening trade. The Pulse is next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Oil prices tumble after the Washington Post reports Israel has agreed to avoid attacking Iranian energy facilities, while OPEC's global oil demand forecasts are cut for a third month. We'll bring you the IEA's monthly market outlook shortly. Now, Bloomberg learns the U.S. is weighing capping the sale of AI chips to some countries, broadening restrictions beyond China. Plus, the British Prime Minister, Keir Starmer, cools speculation that the UK may raise capital tax to as high as 39% as he tries to calm investor jitters ahead of the budget. We'll have more from our exclusive interview. Now, good morning, everyone. There's a lot going on this Tuesday morning. Let's take a look at the European markets map. A lot of the focus, of course, is on earnings. We're in full earnings swing. The focus is not only on the banks in the U.S., but some of the industrials here in Europe. Now, you can see the FTSE down 0.3%. We're seeing a similar loss for the CAC 40 over in France. But then when you look at the FTSE MIB or the DAX, they're actually gaining 0.4%. Oil is dropping, so let's get straight off to cross-asset. Oil dropping as concerns seem to be easing about Israel actually attacking an Iranian energy facility. You can see we put WTI 70.74. Euro dollar, again, we're expecting, of course, the ECB to cut on Thursday. And then there's quite a lot going on in terms of U.S. politics, and that could filter through public spending, and therefore Treasuries 40807. I think our Lisa Brownfitz is also speaking to a Fed official, Mary Daly, a little bit later on. Now, the IEA monthly oil report has just coming out. They say that geopolitical risks are offsetting a plentiful supplies. Now, that's according to the IEA. We'll dig a little deeper. I think they're just breaking right now those headlines, and we'll bring you everything that the IEA is saying and predicting. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, oil prices tumbling this morning. That's after the Washington Post reported that the Israeli Prime Minister Benjamin Netanyahu told the White House he's willing to strike Iran's military rather than oil or nuclear facilities. Now, for more on that and the IEA's monthly report, let's bring in Will Kennedy, Bloomberg's senior executive editor for energy and commodities, and for, of course, wider markets, Seema Shah, chief global strategist at Principal Asset Management, also joins us. So thank you both for being with us. Well, I mean, it's a big day for oil. It's been a big day, I feel, for the last 2 weeks. But finally, I guess the concern about a strike on Iranian energy facilities is not taken off the table, but it's certainly diminished.
Yes, that's right. We hit $80 a barrel at the beginning of last week, and that was pretty much driven by the idea that the Israelis were considering attacking Iranian oil facilities, which would, in the first instance, crimp their ability to export oil and also risk wider conflagration in the Persian Gulf, for which we rely on more than a third of our global oil supplies. Now, the news today that the US has persuaded Israel that it shouldn't do that, I think takes a lot of that risk premium out of the market, and we're seeing the market respond. We're down $3 a barrel, closer to 74, so $6 lower than we were a week ago.
What does this tell us? I mean, there's also this IEA report talking about geopolitical risks. I mean, are we still in a wait-and-see situation?
Yes, I think that, we shouldn't lose sight of the fact that Israel and Iran are in an incredibly tense situation, and that they are there is going to be some kind of action from Israel against Iran, which is a risky thing. But underlying the geopolitical moves we've seen in prices is this broader concern about the supply and demand balance. I think, in common with a lot of financial markets, oil traders were a little underwhelmed by the Chinese stimulus proposals. Oil demand in China, traditionally the biggest driver of demand growth, has been pretty flat this year, and we've got OPEC looking to put more oil into the market next year under current policy. So you put that together, and the underlying picture is for the market to be a little bit loose next year.
Seema, when you look at all of this, we had been discussing that for the last 7-8 months, actually a lower oil price was almost an extra stimulus for the global economy. Does this now complicate things for central banks?
Well, I don't think it complicates things in a way. I think having the high oil prices at this point would have been even more headache, given the inflation numbers that we had last week in the US, given that the market is now starting to say, look, is this even going to be a landing? So I think this does simplify the matter actually a little bit more. The worst case scenario would be if you have that inflation spike, which then takes away all the space that central banks have to cut rates and provide that little bit of stimulus. I don't think it needs much, but certainly some stimulus for the global economy.
But I guess it's something that we can't take off the table. So when you look at central banks trying to engineer this soft landing, inflation is still the one thing that markets seem to be discounting, but I know that a lot of analysts are worried about.
Yeah, absolutely. I mean, I think that's true. That as long as there is the uncertainty weighing over the market, the risk of inflation doesn't disappear. It's something that I think the market have been underpricing. In fact, over the last couple of months, as they've seen inflation decline, the idea that inflation could be a risk had suddenly disappeared, which is why I think you saw such a significant reaction last week. But I think at $80 a barrel, you do need a fairly significant escalation in the situation to get to a point where it becomes a worry.
So what are you buying right now, fixed income versus equities?
So I think actually on the equity, we're generally risk on. So I think there's opportunities in both the equities and fixed income space. In the fixed income space, it's really on the credit side. But taking into account that, look, although we're risk on, we think that the central banks are going to be stimulating. We think the global economy is heading for a soft landing. But that's still a slowdown. So you still need to be focused on high quality within whatever of the risk assets you're looking at. So within credit, this is still kind of cool fixed income, investment grade, the high quality stuff. And within equities, I think there's a lot of opportunities globally. Within the US, we're still maintaining a positioning within the large cap space, because that still gives you that strong balance sheets, cash levels that I think that will still be important as we go into 2025.
Well, we used to talk about peak oil in 2025. I mean, that's certainly pushed back. What's the dynamics with China?
It's a really important question for people in the oil market. Clearly, the EV change is happening faster in China than anywhere else in the world. And the other thing that people are focused on are replacing diesel in trucks with liquefied natural gas. There really does seem to be some displacement of oil demand in China, and I think that's one reason that people are a little downbeat on demand. How fast that's really going to go will depend ultimately on the trajectory of the Chinese economy, and if they do manage to stimulate it and reinvigorate growth, that will have a knock-on effect on demand. But I do think the relationship between Chinese economic growth and oil demand is not as strong as it used to be.
And Seema, when you look at the U.S. economy, there's, again, a lot of concern that actually the slowdown leads to a recession. Are you in that camp?
No, we're not in that camp. But I mean, I think it's automatic that investors hear the word slowdown and they immediately extrapolate that out to recession. That is actually rarely the case. In fact, when I look back over the last 20, 30 years, it's really difficult to get recession. You need things left field to go wrong. You need really weak balance sheets. You need an asset price bubble popping, or you need some kind of significant external shock. And you need central bankers and government to not be willing to come in and assist. We don't have any of those cases on the table today. So we're expecting a slowdown, but we're also expecting central banks to come in. There's not a lot of room, in fairness, for governments to come in and provide fiscal stimulus. But if push came to shove, we do still believe that governments would come in and provide that little bit of help that would be required. But ultimately, look, in the US economy particularly, which of course is going to be the most important segment here, balance sheets for both households and corporates are still in really good shape. So it doesn't need much help to bring the US economy to that landing.
But the labor market is of concern in the US.
It's a concern, but I think that's a little bit overdone. It's something that we need to keep a watch of. We've seen the labor demand has been fading, but none of that has translated over to layoffs. I think the difficulty at the moment is actually looking at the data and translating it when there is so much uncertainty involved in that. I mean, even if you just look at the payroll report, the most recent one, there's a very, very low response rate. You then have seasonality, you then have hurricanes, you have weather effects, which is making it a very difficult picture to kind of decipher. And I think that's probably the biggest risk, that central bankers can be wrong-footed by maybe some of the data, which is a little bit misleading.
We'll talk about U.S. elections a little bit later and some of the policies, but there's a bit of a shift when it comes to fracking between, for example, Kamala Harris and President Biden. Does that translate, does that make a difference to, global consumption?
I think it's pretty marginal. Yes, outwardly, Trump is more favourable to the oil industry than Harris, and of course, Harris 4 years ago called for fracking to be banned. She's dropped that policy. She needs to win Pennsylvania. Pennsylvania is a huge producer of shale gas, so that's just not on the table. I think that the experience of respective Republican, Democrat administration shows you that politics does not drive U.S. oil production. The U.S. oil industry drives U.S. oil production. It's a story about technological innovation and investment, and there's no reason to think that politics will change the dynamic. There are places that the election will be important. I think Iran, Trump was likely to come down harder on Iran with sanctions than the Harris administration maybe. And secondly, people are very focused on this ban on exporting LNG and new terminals there. But I think it's pretty marginal to the dynamics of the oil market.
And Steve, it's very clear that in this U.S. political campaign, China bashing has worked, or certainly both sides are doubling down on it. At the same time, we're seeing extra stimulus coming from the Chinese economy. How do you view that longer term?
So I think the issue with the U.S. tensions with China is something which I think investors actually fully understand. If you ask anyone, I think everyone out there knows that there is a tension there, and they bring that into their expectation for China markets. What I think the stimulus has brought is a bit of an upside surprise. It's questionable how far that's going to take the Chinese economy, how sustainable it is. But at least from a perspective, what has been the surprise into the market over the last couple of months, it's the stimulus package. And I think that's got space to at least move the equity market a little bit further. But I think that, the US election is still another reason why you're finding that some investors are still cautious about getting back into the Chinese market.
Thank you both for joining us. Will Kennedy, they're Bloomberg Senior Executive Editor for Energy and Commodities, and Seema Shah from Principal Asset Management stays with us for more on the markets. Coming up, Bloomberg understands that sales of advanced chips from NVIDIA and AMD could be restricted to certain countries by the U.S. government. We have the full scoop next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Green World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today, with less than a month before Election Day, Republican presidential nominee Donald Trump sits down for an in-depth conversation with Bloomberg editor-in-chief John Micklethwaite at the Economic Club of Chicago. Tune in to Bloomberg Television and Radio for a special edition of Balance of Power at 11:30 a.m. Eastern, followed by the live interview at noon, only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Bloomberg has learned that the U.S. may cap sales of AI chips from companies like NVIDIA to some countries in the interest of national security. Well, let's bring in Bloomberg's executive editor for global technology, Peter Elstrom. Peter, thank you so much for joining us. So what is the idea behind these potential AI caps, and which countries are they targeting?
Well, this is a very aggressive new idea from the Biden administration. It certainly would be quite controversial if they go ahead with it. What they're talking about doing is limiting the sales of NVIDIA and AMD AI chips to certain countries, really targeting by a country-by-country basis who could get this technology. Effectively, what they're talking about is limiting the AI capabilities of certain countries. This builds on existing policies that they've already got. They've been targeting China for a couple of years, a few years at this point. Now they're really looking at the Middle East and some of the countries there that have both the financial resources and also the determination to be able to build up these AI technologies.
So what impact could this have?
Well, it could be quite significant. We've seen some countries in the Middle East in particular be very aggressive in making these investments. G42 in particular has been investing aggressively in AI capabilities. All countries really want to have access. They want to make sure that they have access to AI capabilities down the line. They don't want to be dependent on American companies to be able to supply this. So they want to buy the chips. They want to build the models themselves to make sure that they do have this access going into the future.
We're also back with Seema Shah, who's been with us since the start of the show. Seema, when you look at actually, I mean, for me, this feels very significant because it's actually a redrawing of trade, which has started probably 2-3 years ago, also with the U.S.-China tensions. But does it change, where you want to be invested if certain countries are considered friendly to the U.S. or not, and actually all trade changes because of that?
So I think so we certainly can't ignore it. The tariff side of it is, to be honest, I think that from the tariff perspective, it's really something which impacts our international exposure rather than how we think about the U.S. In particular, with this specific news, we are a little bit skeptical about how far the U.S. is willing to go with it. Because, of course, it ruins a relationship going forward. It's something they need to keep an eye on. There's a balance for them. So I'm skeptical about how far they would go. But certainly, if there's anything that we're going to be looking at, it's going to be how is the international arena impacted here.
Does it change trade? Have you had, do you have to take bets now on where trade flows to and from because of geopolitics?
Yes, we do to some extent. It's one of the reasons why I think for example, for Europe, it's one of the reasons that we maintain a longer-term underweight in that region, because we do worry about where the trade flows. How is the US going to respond to Europe? Where does Europe fall in with regards to the US-China tensions? Is one of the things that we do take into consideration. But again, this is not new news. this is something which has been sustained for a while, which I think has been built into many of the portfolios already.
Yeah, and Peter, to Seema's good point, I guess, a lot of it is probably built in, but do we know the reaction of the chip makers and the countries targeted and how they could retaliate?
Well, this news just came out. I mean, our reporters were able to break this news, fortunately, to find out exactly what they're doing. But you raise a very good point. It's not clear at this point how the companies are going to react to this and how the countries themselves that could be affected are going to react to this. NVIDIA, just to take the leading example in AI chips, has had mixed feelings about these trade restrictions. You've got the company run by Jensen Huang, a Taiwanese guy who came to Silicon Valley to make his fortune. He's built a $3 trillion company. It's really built on globalization. They want to be able to sell into China. They want to be able to sell into the Middle East. They want to be able to access these markets because it helps them develop their technology more quickly and innovate more quickly.
What's your take on technology in general? I mean, apart from these, I mean, again, this could put into question a lot of certainly, individual chip makers' modus operandi. But in general, is NVIDIA like all player takes all?
Yeah, so in general, we've maintained that overweight to that large cap tech space. There are some, we have to take into account the valuations are really, really frothy, and its expectations are very lofty, and probably more lofty for the near term. I think for the longer term, we certainly believe in that opportunity set. But also, in this environment where we are expecting a soft landing, you should see a broadening out of other sectors, other companies. So in that situation, I think an investor should be asking themselves, do you want to be increasing your exposure to something which is already very expensive, and where there are some concerns maybe brewing about where they can deliver? Or do you want to go into other areas which have got that opportunity still to go, given that they haven't yet almost had that catch-up trade?
Do you make that decision based on earnings coming up? Or do you have to be longer term?
You have to be longer term. We almost have to be looking beyond where it is in the near term. But certainly in this environment, there are certain areas that we would like. There's stuff like financials, industrials, which should perform well in this environment if you still expect to see a soft landing.
All right, so thank you both for joining us. Seema Shah, Principal Asset Management, and Peter Elstrom, Bloomberg's Executive Editor for Global Technology, with that pretty incredible story that Bloomberg broke, saying that the Biden administration, having discussed capping sales of advanced AI chips from NVIDIA, but also other American companies to country-specific bases. Coming up, why German car makers are getting left in the dust by Chinese EV makers in their biggest and most lucrative market. We'll look at their challenges next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Well, today's Big Take looks at how German car makers have lost the fight for the EV market in China and how winning it back will be a fight. Volkswagen, Mercedes-Benz, and BMW all reported a slump in third-quarter sales in China. Let's get more with Bloomberg's Oliver Crook, who joins us from Brussels. Ollie, thank you for joining us. So can German car makers actually make up ground?
I think it's going to be very challenging for them, Francine. And just to illustrate how challenging it's going to be, when we talk about those third-quarter numbers, I mean, we're talking about absolutely huge sales decline in China. For Mercedes, it was down 13%. For Porsche, almost 20%. For BMW, down 30%. That means that BMW lost almost a third of its sort of biggest market in the third quarter. That is absolutely huge in terms of, you think of the scale of that. In terms of bringing it back, it's not just a question of the Chinese economy recovering and demand coming back. The question is, once that demand comes back, is it going to be for the German cars? More than 50% of all the cars that are sold in China right now are EVs, and the German car makers are just flatly behind on the technology and really sort of the digital side of the car. For the Chinese market, that is absolutely crucial. So it's going to be a very difficult uphill battle for them to fight back.
Europe has an EV demand problem. How do you solve it?
Yeah, so listen, this is one of the big questions before all of the CEOs that we spoke to yesterday. They say that they're starting to see some of the demand come back because they've managed to lower their prices a little bit. But I think that one of the main issues that you've got is next year you have new regulation coming in. These car makers need to, according to the laws out of Brussels, sell a fifth of their cars have to be EVs. We're nowhere even close to that, Francine. We're at about 15%. In order to get there, says Carlos Tavares, the CEO of Stellantis, you need to get a demand side sort of stimulus into the economy. Have a listen to what he had to say to us yesterday.
Right now, we only ask two things to the governments, and specifically the European governments. We ask stability of the rules. We do not ask for any kind of postponement because we are ethically committed to contribute to fixing the global warming. So we don't ask for any postponement. We ask for stability from one side. And from the other side, we ask the governments to stimulate the demand, which is not to help Stellantis, but to help the consumer, so that the consumer can buy EVs at an affordable price.
So you have a sort of mismatch between where the market is, what the market wants, and what policymakers want. And what you hear there from Carlos Tavares is that you really need to have that demand stimulus if you really want to get the sort of targets that you want to hit here in Europe. And that is going to be very challenging, Francine.
Ollie, thanks so much. Oliver Crook there with the very latest from Brussels. Coming up, following a rocky 3 months in power, our exclusive interview with the UK Prime Minister Keir Starmer. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries
are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil prices tumble after the Washington Post reports Israel has agreed to avoid attacking Iranian energy facilities. Meanwhile, the IEA says geopolitical risks are being offset by plentiful global supplies. U.S. chip giants fall pre-market as Bloomberg learns the U.S. is weighing capping the sale of AI chips to countries, broadening restrictions beyond China. And the British Prime Minister Keir Starmer calls speculation that the UK may raise capital gains tax to as high as 39% as he tries to calm investor jitters ahead of the budget. So let's stay with that exclusive interview. The UK Prime Minister Keir Starmer's government is touting £63 billion of investment from a key summit on Monday. Well, Starmer is seeking to draw a line under the rocky first 3 months in power that saw his negative rhetoric about the state of the public finances weigh on economic sentiment. Well, he spoke to our very own head of economics and government, Stephanie Flanders.
Well, quite a lot of speculation is getting pretty wide of the mark, but
so you say that 1339 is wide of the mark?
It's getting to the area which is wide of the mark. But I'm not going to fuel the speculation because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget. So that's why we put the timing as it is. It's the right timing. But equally, it's been really fantastic to have this investment summit just a few weeks before the budget, where the mood music here is very upbeat. People are talking about a real opportunity now to invest in the UK, comparing it as a relative advantage across the world. We want to seize that opportunity and take it forward with many of the investors that are here.
You said it's the right timing for this summit. It does feel a bit odd that for those people in the room, people who are doing deals today, you can't promise them that the basic tax environment for entrepreneurship, for business, for wealth in a couple of weeks' time won't be completely different.
Well, they're very interested that corporation tax is capped. They know exactly where that is in the long term. They're very interested in the fact that we're able to say that because we've got a good, strong majority in government, we're able to make decisions based on years, not months, with a clear strategy. They're very, very interested when I talk to them about being a mission-driven government, a government with a real sense of purpose measured over years with one central purpose, which is wealth creation translated into jobs in different parts of the United Kingdom. That's the sort of stability that they're looking for, and that's the conversations we're having. They're very pleased to hear that from a government, very pleased about the clarity. There's no end of people here today who said the clarity of the message is really welcome. It's now the follow-through, which is actually the execution of it. What are you prepared to do when it comes to planning? What are you prepared to do when it comes to regulation? It's not just the number of regulations, it's the inconsistency of regulation that we need to deal with. And when I'm able to say with real confidence and certainty and clarity, yes, we're going to deal with that, that leads the decisions, in my view, to make the sort of investment that we've seen in recent weeks, which is very welcome. These are not just big numbers, although they are big numbers. They translate into jobs around the United Kingdom, good, well-paid, secure jobs. And that's the change we promised at the election and the change that I'm determined to deliver on.
Well, that was the UK Prime Minister, Keir Starmer, speaking exclusively with Bloomberg's Head of Economics and Government, Stephanie Flanders, who joins us now. Stephanie, it was a great interview. It was the first time he spoke to us at length since being elected in July. And he has this tricky situation where he has to kind of, keep investors here whilst at the same time, commit with what he promised in the manifesto.
Yeah, and I have to say, the mood music leading into this was not very promising. You've got, as I mentioned to him at the beginning of the interview, you've had sort of plummeting consumer and business confidence since they were elected. But not entirely due to them, but actually a lot of underlying economic figures have looked quite good. And a lot of business leaders are concerned about what they keep saying about the difficult challenges facing the UK economy, possible regulatory changes coming through in the labour market, tax changes, primary taxes on wealth and capital gains, all of that concern. So there was always a question mark, how are you going to talk up investing in Britain when you've spent the last 3 months talking about what a basket case it was? I think they pulled it off in terms of the day itself. I think, they had good turnout. A lot of the major heads of the banks and the investment community, a lot of private equity folks were there, and they had done the sort of requisite number of big-sounding deals. But that fundamental challenge that I was also putting him into the interview, you can't promise that the tax situation is going to remain the same over the next few weeks. That was just an underlying tension.
So, and you're absolutely right. They had, it was 100 days since they got elected yesterday, and it's been, frankly, rocky. Is this because of how they communicated, or is it just because there was too much time between the day they got elected and this budget on October 30th? A lot rides on this budget.
I think there's any number of things. I mean, in principle, you could have said, and this is what the Chancellor said, we need to take our time, we need to open the books, there's no point doing a rush budget. In opposition, I can see the case for that. In government, when you have all of the focus on the budget, I think leaving this amount of space, especially when you've injected a few key, very difficult decisions already into the debate, like the winter fuel allowance, taking that away from a lot of older people, when you're not sort of offsetting that with other positives, new spending on NHS, whatever it is. So I think a lot of those things that look smart in opposition suddenly didn't look smart. And actually just their straight day-to-day management has not been as competent as we might have expected. They didn't seem to be ready for government at number 10 or in many of the departments.
So, Stephanie, what happens now? Again, it's 2 weeks until that budget. Are they still going through the numbers to see if people leave, then you kind of lose that tax revenue that you could get by hiking taxes? Is it like a
So I was looking
balance?
at, this is one of those times where we start going through the timetable for the Office for Budget Responsibility, because that's the big difference, right? It's quite hard to do very last-minute changes now because you have this fiscal watchdog that has to have run the numbers on whatever you've decided to do. And as of yesterday, they're supposed to have been given the primary measures to the fiscal watchdog so that they can then say, this is what would happen if you did X, Y, and Z. There's still going to be plenty of change between now and the 30th, but I think we are in the final straight just because of that need to have the numbers go through that watchdog.
So the main questions are capital gains tax, private equity, which is maybe why you had a lot of private equity also showing up yesterday
Yes.
at the investment summit.
I think so. And I think what is interesting is we thought all these major tax rates were off the table, right? Because they'd gone into the election with a pledge saying taxes on working people won't go up, we won't change the national insurance rate, income tax, the VAT, these main forms of taxation. So we thought we didn't have to worry about that. Yesterday, I think there was some lack of clarity introduced by the Chancellor about whether the pledge on national insurance applied to both the employer side and an employee side of national insurance. It's a very arcane bit of the tax system. There actually isn't that much difference between the two, but technically she might be able to argue she was raising taxes on companies, not on workers. I think workers end up paying either way, and it's going to look like a breach of the pledge, but it does seem that there's the possibility they're going to get some money from that.
Stephanie, how does this country grow? Again, if you talk about growth, you know, it's an industrial plan. It's, I know I keep on hearing risk-taking. I don't even know what risk-taking looks like. You know, do you force pensions to invest more in UK companies?
I mean, the big problem for the UK has been, on the public and the private side, is lack of investment. And if you look at the sort of single, you know, the economy is a third smaller than it would have been if we'd just grown since the global financial crisis at the previous trend. Now, everyone else is off their trend as well, but we're particularly off our trend. What's the main contributor to that? There's been a long-standing shortfall in investment. And I think we may see from the budget, you know, room for more public investment, but the private investment has to come through. And as you suggest, you know, some of that will be about encouraging people to invest in the UK who might be kind of hardwired in the city to invest overseas instead.
Yeah, and then if you look at France, I mean, they're raising taxes. You had a conversation with Emmanuel Macron. Italy's also raising tax in some of their most viable companies. Germany, frankly, isn't doing great. So the UK is also looking okay comparative to other countries.
Yeah, I mean, in terms of certainly even on that basic measure I just used, I mean, I think the Eurozone is almost as far off where it should be. And I think if you were looking at some of the sort of fundamental drivers of growth, you wouldn't think that France or Germany was in a better state. They do have, though, much more productive workers. I mean, that's the other piece of this that we always talk about is productivity. I think the French are actually 20%, 25% more productive than us. They're manufacturing workers. So, you know, that's, again, what the investment needs. If you give machines to workers, they're able to make more stuff for the same amount of money.
Okay, but they have more holidays. Stephanie, we need to get to the bottom of this. Stephanie Flanders, of course, stays with us. Coming up, we talk U.S. as the U.S. election hangs in the balance. We'll bring you the latest on the race for the White House and what it could mean for the global economy. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Welcome back, everyone. Now we're just 3 weeks away from the U.S. election, and right now, well, the race for the White House is just too close to call. The former President Donald Trump will be sitting down with our Bloomberg editor-in-chief, John Micklethwaite, a little bit later. Meanwhile, a gauge of expected yuan swings hovering around the highest in nearly 2 years as traders brace for the risk of tariffs on Chinese exports if Donald Trump wins. Well, still with us, Bloomberg's Stephanie Flanders. Stephanie, thank you so much for sticking around. Look, by all measures, the U.S. economy is kind of firing on all cylinders, but so many question marks about taxation, tariffs, even at 1,000% if you believe what Donald Trump has said.
Yes, and I think, there's always been one of these consistent complaints, if you like, of the Democrat side, whether under Biden or Kamala Harris candidacy, that the population wasn't giving this administration enough credit for the strong economy. But of course, it looks strong to the rest of the world. If you're sitting in the US, you still feel like your energy bills, your food bills are much higher than they were. And the fact that your wages have also risen, they still feel like their life has got more expensive, and they have very much punished the Democrats for that. Now, Kamala Harris has kind of narrowed the gap to some extent on the economy, but that sort of basic issue, which faces any incumbent party, I think is still a kind of underlying drum roll for this campaign.
Why is the race too close to call right now? It feels like Kamala Harris, since getting the nomination, had gained so much ground, and now is kind of like flatlining.
I think it's, people talk about the calcification of the US electorate. I think it turns out people really aren't going to change their mind. A vast majority of voters, especially the ones who are planning to vote in November, are pretty fixed. They have a fixed view of Donald Trump, love him or hate him. They have had a fixed view of the Democrats. I think Kamala Harris was able to make up the loss that was sort of, the cratering, some would argue, certainly the decline in support that we saw for President Biden when there were concerns about his age. But there is just this very small sliver that we've been talking about for at least, for several years of undecided voters who they are now fighting about. I think that, the Democrats are clearly nervous that the momentum, as you say, that Kamala Harris had, she seemed to have lost over the last few weeks, didn't seem to get as much out of that very strong debate performance as we expected. There could be a lot of explanations for that, but they are desperately trying to think, how do we, because she should have a higher ceiling, as they like to say, for her vote than Donald Trump, but it's not becoming evident at all. They're basically both stuck on the same percentage of voters.
I know both candidates are really focusing on the swing voters in Pennsylvania, and I guess to try and cut through that, it's all about the economic plan. Are we going to see shifts from the Harris camp? Maybe I know on fracking, she's a lot more fluid on it than Joe Biden was.
Yeah, and I think she clearly had a position that she's had to reverse, and then that feeds a sort of narrative about flip-flopping. There's been a big debate within the Democratic Party of whether or not you should go on to the economy or just run the risk that people will be reminded of some of the bad things, or do you need to sort of address that directly rather than trying to just raise fears about Donald Trump? They're clearly trying to do everything without seeming to panic. I think they're also very crucially in the last week, they've been targeting Latino and African-American voters who, more of them are voting for Kamala Harris than maybe a few Democrats than a few weeks ago, a few months ago, but still it's much less than in 2020, and that could be a crucial margin. So you see her going on a lot of platforms on social media, TV shows that are targeted to that audience.
I mean, I had one big Wall Street chief executive say, a lot of people would like Kamala Harris's personality with Donald Trump's economic plan. I mean, is it really on personality and the economy that this will be won or lost?
I find it really weird when business people say that. Not because, obviously there's a lot about any Republican agenda, Republican president, that the business community is going to feel more comfortable with, and they would certainly feel more comfortable with a business person as president than a sort of prosecutor from California. But when you look at his plan, and we've done the numbers, the economists have done the numbers, there is a widespread agreement it would mean higher inflation, specifically through tariffs, the increase in prices that comes from that, but also more broadly from the making the tax cuts permanent, all of these things, and would add enormously to the deficit. The Trump trade is higher Treasury yields, higher inflation. It's odd to me that Wall Street should be so much keener on that than a slightly more stable scenario.
Yeah, certainly counterintuitive, Stephanie. Thank you for joining us. Bloomberg's head of economics and government, Stephanie Flanders. We'll see a lot more of Stephanie throughout the coming weeks. Now, coming up, Citigroup, Goldman Sachs, and Bank of America report earnings later today, so more on what to expect from those banks next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Citigroup, Goldman Sachs, and Bank of America are likely to flag rising revenue pressures in earnings reports later today as the Wall Street giants start to reckon with the Fed's rate cuts. Now, for more on this, I'm joined by Bloomberg's Charlie Wells and Filippo Aloati, head of financials at Federated Hermes. So thank you, Filippo, for joining us. Charlie, thank you as well. I mean, I do feel we're joking around that it feels like every week is, Wall Street earnings day. They've come around quickly. What are we expecting today?
They really have. I mean, look, they have some tough numbers to follow because J.P. Morgan, beat expectations on net interest income and on investment banking revenue. We saw Wells Fargo beat last week as well. And so expectations are really high. I mean, the KBW Bank Index is outperforming the S&P 500. Bank stocks are doing really well. And it's just looking like investment banking should bode pretty well across the board. There may be some differences, between Goldman. They warned last month about trading. Bank of America warned about investment banking fees. And the other really big picture that I think we want to focus on here is the consumer, because Citi had been talking about some issues with credit.
Yeah, and this is the problem. You cover credit, but also how much of these are stories about, regulation, about, the forthcoming U.S. election, and how much is it just on the economy?
Yeah, it's always comes down to the economy, and banks are doing very well versus the S&P 500 because the economy is strong. 4.1 unemployment rate, 3% projected growth, and a relatively stable but coming down inflation. So they are all positive tailwind for the banks. Now, of course, so the problem becomes as rates will hopefully gently come down, then the banks also will learn less from the net interest income. And that's why Pinto, JP Morgan, and also the other CEOs that were putting water on the fuel say maybe the analysts got ahead of themselves, as they always do. They're more focused on IBD and potentially on the equity capital markets.
Yeah, and Dan Pinto, as you said, JP Morgan there, where he's president, Charlie, basically, made that difference or tried to temper expectations. But JP Morgan, by all counts, are doing great.
And then they beat. And I think one of the issues is, that, rate cut was only a few weeks ago. And so it's not clear how much that would have played into the results from this quarter. And I think it will be something that net interest income conversation is something I think we'll be hearing a lot more about as rates potentially, as you say, are cut even more. To what degree does that start to show up in these earnings? I think the third quarter of this year, maybe not so much for the other banks that are going to report today.
And Filippo, when you look at loan growth, when you look at, for example, securities portfolio, what do you find more interesting in terms of metrics?
Yeah, it's actually a combination of all of those metrics, because we know some of the banks, like, for example, Bank of America, Citi, to some extent, they have very large liquidity portfolio. And of course, so if rates coming down, they need to juggle the liquidity ratio, the available for sale and hold to maturity portfolio, and of course, also the loan growth, which at the moment is almost even though the economy is growing 3%, it's quite dull at the moment. And we know there are some cracks appearing, like, for example, commercial real estate, which hasn't really been a focus so far in the quarter, also because the banks they're reporting are relatively insulated in terms of exposure to the office market. But I think with the regional reporting, it will be more, the market will spend a bit more time on commercial real estate.
Do you have any worries about the regional banks?
The regional banks are actually interesting. They outperform the money center, the big guys, because they say if there is a soft landing, or actually even there is no landing at all, and the economy keeps chugging along at, say, 2.5% GDP growth in 25, which, I mean, some government in Europe would kill to have this type of growth, then in theory the regional should outperform that's what history say. But of course, the question is, will be a 1990s with lots of loss on the commercial estate, or more 94, 95, where actually some sort of hiatus in the economy permit the banks to ride out of those cracks that are appearing.
And Charlie, I mean, I know, it's interesting when you hear Jamie Dimon, he says, yeah, all these numbers are fine, but actually you're missing the bigger picture of geopolitics and how that changes everything.
He was incredibly gloomy on that. And I think, his CFO was fairly sanguine on the economy at large, but, Dimon talking about a lot of the risks, sounding a very kind of gloomy tone. I think something else that is striking that we heard kind of on the gloomier front, even from Jeremy Barnum, the CFO, was the U.S. housing market, right? He said it was a little bit stuck. And I think as we pivot into that lower rate era, that would be something that you would want to see from these banks, that housing market, these mortgages, come in and maybe make them some more money on those loans.
When you look at the European banks, I know you cover also UniCredit, I mean, do we need some kind of, cross-border consolidation? It could be UniCredit, Commerzbank, or something else to try and at least compete with Wall Street.
I think so, and I think it's like Darwin evolution, where the rules cannot really implement this banking union, the so-called top-down. Maybe it should come from bottom-up. I don't know if it's going to be Andrea Orcel or some other CEO, but I think also we need these animal spirits, what you were mentioning before, the risk-taking. So we need some CEO that put out a positive case for more European integration and say that makes financial sense. And then if it makes financial sense, it will be approved by the shareholders, because at the end of the day, those banks belong to shareholders. And the shareholder approved, then some other CEOs, they could be emboldened and say, oh, what Andrea is doing in Germany actually makes sense between France and Netherlands, or France and Spain, or whatever. I think we need more of these kind of deals, yeah.
Thank you both for joining us for a terrific briefing on everything happening with the banking sector. Filippo Aloati, head of financials at Federated Hermes, and Bloomberg's Charlie Wells. Now, you can watch Bloomberg's editor-in-chief, John Micklethwaite's exclusive interview with Donald Trump, 5 p.m. London time. I know I'm looking forward to that interview. When you look at markets, look, oil falling for a third session, a report that Israel may avoid targeting Iran's crude infrastructure. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is off for the week. Welcome to Bloomberg Brief. Let's set your agenda. Oil slumps, crude drops for a third day on speculation that Israel will not strike energy sites in Iran. Another record, stocks notched their 46th all-time high of the year. Nvidia posts its first record since June. And bank earnings continue. Bank of America, Goldman Sachs, and Citi all on deck. So we await the earnings. We also have J&J reporting today, too. We're going to get Netflix later in the week. Weaker across the board for your equity futures this morning, led down by NASDAQ 100. We did have our 46th record high, and Bank of America pointing out that investors added the most to equity since June 2020. We are at peak optimism. For this bond market, not a whole lot of movement this morning, maybe slightly lower across the curve, save for the front end. Yesterday was a holiday for this bond market, so not a lot of movement. Maybe some of the reason the longer end is coming down is because of oil. Let me show you this quickly. Down 6.3% over the past 2 days. That follows a Washington Post report that if Israel conducts a strike, it would be on military sites, not energy. So some of that geopolitical risk premium getting priced out here. We've also had a lot of Fed speakers really over the past 2 weeks, and the strong data. Minneapolis President Neil Kashkari said yesterday that it appears that further modest reductions would be appropriate. Meanwhile, Governor Christopher Waller spoke on the path ahead, also with less urgency.
This data is signaling that the economy may not be slowing as much as desired. While we do not want to overreact to this data or look through it, I view the totality of this data as saying monetary policy should proceed with more caution on the pace of rate cuts than was needed at the September meeting.
Joining us now is Andrew Sheets, Global Head of Corporate Credit Research at Morgan Stanley. Andrew, thanks so much for joining this morning. It's really great to see you. So modest reductions, further caution. It's a Fed official after Fed official trying to steer us away from the rapid easing. What in your mind does this path actually look like for the rest of the year?
Yeah, thanks, Danny. Good morning. It's great to be here with you. So I think what we're looking at is a modest reduction. You know, our view at Morgan Stanley is that, you know, the 50 basis points that we got in September wasn't some new pace setting. It was a larger kind of one-time adjustment, and that the pace from here is going to be 25 basis point cuts, much more modest reductions. And if the data comes out better than the Fed expects, then maybe they could even do a little bit less than that. And I think for markets, that's good. I think if we look back at history, the Fed doing a little bit less than expected, the Fed easing in a shallower pace is fine, as long as that is accompanied by good data. And in some cases, that's better. That's a better outcome for markets than weaker data and the Fed cutting a lot more.
Yeah, we talked about this last week, Andrew, this idea that good news is good news again. But with that good news, you have seen some more pricing of inflation risk. 5-year inflation swaps, the biggest jump over the past 5 weeks since early March of 2023, just before SVB's collapse. Does there get to a point, and are we anywhere near it, where the good news becomes bad news for risk?
Yeah, no, I think that's absolutely the right question, and that's a question that's been coming up in our conversation with investors. And our view on that is not yet. I think we still have some time before the data is almost kind of too good and starts to worry the market again. And I think there are kind of a couple of specific elements around that. The first is, I think that the metric you mentioned, inflation break-evens, is absolutely the right thing for investors to focus on. And if I think about kind of 2-year inflation break-evens, right, what is the market thinking that CPI will be over the next 24 months? That's at kind of 2.1 in PCE terms. The Fed's target, maybe that's 1.8, 1.9, still very much kind of in line with inflation being at target or even a little bit below target. Now, I think if we saw those inflation expectations get up to 2.3, 2.4, well, I think then you can start to make the case that the market is saying this is too hot. This is now the Fed losing control a little bit of inflation, but we're not there yet. And also, I think if we just take a step back and think about what asset allocators, investors usually worry about most. Usually, I think what they worry about most is growth rolling over. And if growth holds up, there, I think, are a lot more instances where markets can hold up, and markets can hold up at pretty above average valuations under those conditions.
And you see that in credit markets. I mean, they could scarcely be more optimistic than they are right now. Does that very fact, Andrew, worry you that there's so much optimism baked in despite all of these tail risks from geopolitics to U.S. election and otherwise?
Yeah, so it's not worrying us yet, I would say. So at the moment, we are still forecasting tighter spreads over the next 9 months. We do think this is an environment of a lot of moderation in growth, moderation of inflation, moderation of policy, and we think credit is an asset class that really likes moderation. So for the moment, we think it's fine. I do think, though, we have to keep an eye out over, do we see signs that that's going too far, specifically that companies are looking at those borrowing costs and saying, well, that's great. We're now actually going to be a lot more aggressive, that these spreads are so tight, these yields are so attractive, we're going to borrow a lot more. Because I think in the absence of a recession, and again, this is where the recent data is so helpful, I think has lowered the odds that the data is deteriorating more rapidly. Well, if it's not going to be that sort of growth downturn, then the other thing that would get credit in trouble would be much more corporate aggression, much more corporate optimism. We're just not quite there yet.
We also were likely to get just the deluge of bank issuance as we work our way through their earnings. Just how favorable are conditions for the financials right now?
Yeah, I think that is something we need to keep an eye on. And I think, again, there's some balance here between there is still some of that supply pressure, but the banks are also reporting pretty good earnings, a quite strong capital position, and that's also helpful. So from our perspective, we're still favorable on the financials relative to non-financials and credit. We like that in the U.S., we like that in Europe, but I do think we need to keep an eye on that supply, and we do need to keep an eye, especially as you move, into the U.S. election and past the election, whether any sort of political or regulatory change shifts that picture.
I wanted to go there to the election, Andrew. How much do you understand of the deluge of debt that we've had over the past few months? Are corporates trying to front run the election? And it looks very different once an American election takes place.
Yeah, no, I think that is an important factor of what's going on. We've seen a lot of issuance. We've seen a lot of issuance in the U.S. We've seen a lot of issuance in Europe. And we do think that this kind of election uncertainty, just wanting to get out ahead of it, get your funding done, kind of not leave a lot of undone funding to the fourth quarter, to the very end after this event, is something understandably that corporate treasurers have wanted to do and are doing. And I think this is the case in the U.S., where obviously that election is much closer to home. But I think this has also been the case in Europe, a reason why European issuance has been so high despite otherwise kind of relatively tepid European growth. And so our expectation is that that issuance will slow post-election, that companies will have done a lot of what they've needed to do. Obviously, we need to kind of see that, but that is currently our expectation, that there's been a lot of front-loading this year.
Do you understand how this credit market might react, Andrew, to an election where we don't know for some time what the results are, a contested election, something that even needs to make its way to the courts? Is that risk appropriately priced in?
So I think, this is a hard question to answer. We generally operate under the assumption that credit likes moderation, credit likes stability, and I think the scenario that you imply is a not moderate, not stable outcome. And so it's certainly, I think, more challenging, presents some risks there. Look, I also think that this is a case where the makeup of what Congress looks like under that sort of contested election scenario also matters. I think if you are looking at a scenario where it's more likely to be a divided Congress, then I think the market could look at that and say, well, that reduces the odds of large legislative change. That's good, I think, from the eyes of credit. Again, kind of operating under the idea that credit likes moderation, credit likes kind of cutting off the economic tails. But if it looks not like that, if it looks like we could get a more united government scenario, then that could also raise some greater kind of economic volatility and something that maybe the credit market likes a little bit less.
Andrew, really wonderful to get your thoughts, as always. That's Andrew Sheets of Morgan Stanley. Okay, let's get to some of the other top stories that are trending on your terminal this morning. Chinese tax authorities are moving to collect overseas investment gains from the country's ultra-rich. They've begun to ask individuals to come in for payment evaluations or request a self-assessment. The government has been urgently trying to expand its sources of revenue as land sales have tumbled and growth has stalled. Sources tell Bloomberg that Tesla had humans control some of the capabilities of the Optimus robot prototypes at its recent showcase. Elon Musk was at the event and told the crowd that the humanoid androids would be the biggest product ever, but he didn't disclose the human helpers. The event was intended to generate investor buzz for upcoming products. And Donald Trump's latest town hall in Pennsylvania was derailed after multiple audience members fainted last night. The Republican presidential nominee had taken the stage 40 minutes before. The sweltering heat caused more people to faint, so then Trump pivoted from the usual Q&A format to transform the event into an impromptu dance party. Well, former President Trump will be sitting down with Bloomberg's editor-in-chief, John Micklethwaite, for an exclusive interview exactly 3 weeks from Election Day today. Catch that interview 12 p.m. New York time, 5 p.m. in London. But first, coming up on this program, oil extends its losses. Israel signals that it won't target Iran's energy infrastructure in a retaliatory attack. Later in the hour, we're also going to be catching up with RBC's Amy Wu Silverman on the dramatic change in sentiment in the options market. Don't miss that. Stay with us on your Bloomberg Brief.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief on this Tuesday morning. I'm Danny Berger in New York. Oil prices tumbling yet again this morning, down 4.5% for Brent crude. The Washington Post yesterday reported that Israeli Prime Minister Benjamin Netanyahu has told the White House that he is willing to strike Iran's military rather than oil or nuclear facilities. For more, let's bring in Bloomberg Horizons Middle East and Africa anchor Jomana Bercecci and Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Jomana, can you lay out for us exactly what it looks like Israel is now considering?
Yeah, that's the question, Danny, because after the October 1 Iranian missile attack on Israel, it became apparent that Israel was going to respond. And we discussed a whole menu of different options that they could go for. The concern, of course, is that the most nuclear option would be for Israel to go after the nuclear facilities in Iran. But then increasingly, and you began to see this being priced into some of these oil markets, geopolitical concern about the possibility of them targeting oil infrastructure. Now, in the past couple of days, there have been several outlets, not just Washington Post, but also NBC on Friday afternoon, saying that according to their reporting, discussions have taken place at a high level, high security level within the Israeli cabinet, in which focus their response mainly on some of those military infrastructure targets and possibly on IRGC commander level, as opposed to going after nuclear targets or even oil infrastructure. Now, this is key because we know that the U.S. have been exercising some diplomatic influence there. There are ongoing channels open. The Prime Minister this morning, Israeli Prime Minister, put out a statement saying, we listen to the opinions of the United States, but we will make our final decisions based on our national interests. But two other important developments just to note here. Number one, we spoke about this yesterday, the Pentagon has licensed the use of their sophisticated air defense system called THAAD, and that is expected to be operational in the next couple of days. So the U.S. are helping Israel bolster their air defense system. And the second development is that late on Friday, the U.S. also announced that they are introducing further sanctions on the Iranian oil industry, which again is notable because it tells you that when Israel is thinking about the package of response to the Iranian missile attack, it also comes along with some assistance in the form of this sophisticated air defense system from the U.S., alongside those new sanctions that are being applied to the Iranian oil industry as well.
Right, maybe that's the thing that gets them to listen to the U.S. rather than Biden just demanding it. And well, Jomana mentioned what's happening in energy. Oil prices down another 4.6% for WTI this morning. Just how much geopolitical risk premium has now been taken out of this oil market?
Because if we think back to early last week when people were really worried about Israel hitting Iran's oil facilities, it came after Joe Biden acknowledged that that was part of discussions between Washington and Israel. We saw oil prices hit $80 a barrel, the highest in several months. Now this morning, we're back down below 74. So we can really see that the Brent oil price has responded to a perception that the risk of strikes on the oil market and the impact on oil exports has diminished, and I think the focus increasingly, and it has been for several days, is actually on the state of supply and demand. Some disappointment is common with other financial markets about stimulus from China, and just a sense with OPEC getting ready to perhaps put more oil into the market next year, and concerns about demand, that the oil market isn't looking that tightly balanced as we go into 2025.
Well, just to that point, the International Energy Agency out with a report this morning saying oil's geopolitical risks offset by plentiful supplies, and lists a lot of the reasons you're listing. Does that mean to say even if the geopolitical risk continues to be live and well, that there's a clear ceiling for this oil market because of the supply?
I think it's far too early to say that. Clearly, despite the news today and clearly the impact that it's had, the situation in the Middle East remains very volatile. It remains fraught with risk, and I think oil traders will not ignore it. I think the flat price market clearly signals that lessening concern, but traders have also been taking a lot of protection against some of these risks in the option markets, and they will continue to monitor the situation and be alive to it. Yes, the supply and demand picture cushions some of those risks, and I always say the other cushion is the fact that OPEC Plus has a large degree of extra unused supply, idle supply that it could bring into the market if it wanted to. But I think the market is still very conscious of what's going on in the Middle East.
And fair enough. And so let me give you the last word, Jomana. Only about a minute here, but if Israel does have a more muted response, something like military bases, how do we understand what the response from Iran will be to the response from Israel, that's the response to Iran and so forth?
Yeah. I mean, that's a big question. And we were speaking to Patrick Sykes, who is our Iranian correspondent, just a couple of days ago, and he said they've moved on to the second derivative in Iran now. They're talking about the potential response. But from what we understand, and from the language that has come out of the Iranian regime, there's been a lot of rhetoric, but there certainly isn't the perception out there that Iran want to get ensnared into this broader conflict. And again, it all comes back to the state of economy, which is crippled by sanctions. And you've got to think that they are also not in a position now to want to make this be escalated even further.
Okay, Jomana, Will, thank you so much. That's Bloomberg's Jomana Bersecci and Will Kennedy. More to come on your Bloomberg Brief.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
You're watching Bloomberg Brief. Danny Berger here in New York. Let's get you some front page news. A look at what's making headlines around the world. First up, the FT has this on the front page. The U.S. election bets are surging after a court lifted a ban. Institutional investors are placing millions of dollars in new wagers after being placed after Kalshi, a betting forum, won a court victory in Washington over a U.S. regulator and just fully opened the market. Bets do narrowly favor Trump over a Harris win. Next up, the New York Times has this on the front page, that Canada has been expelling Indian diplomats, accusing them of a criminal campaign, orchestrating homicides and extortion in Canada to intimidate Sikh separatists critical of India. Canada expelled India's top diplomat to the country and 5 others. India did reciprocate, expelling 6 Canadian diplomats. And on the Bloomberg this morning, the U.S. has been weighing capping NVIDIA, AMD, AI chip sales to some countries. The Biden administration is weighing implementing the cap on a country-specific basis. That all according to Bloomberg sources. For more, let's bring in Bloomberg's Tom McKenzie. Tom, what timing for NVIDIA? Hitting a new record high, riding high. What exactly are the details of this?
Yeah, absolutely. So look, we're going to be watching NVIDIA pre-market, right, on the back of this news to see how it reacts. It's up 14% so far in the month, about 200% over the last 12 months or so. Will this prove a headwind? So this is further evidence that the Biden administration continues to build out their framework. Oops, on that front, technology dropping at my feet. Talking of technology, build out that framework around the restrictions that they're now applying around some of this technology. Of course, the AI accelerators, the GPUs manufactured, designed at least by the likes of NVIDIA and AMD, of course. The latest news is that they're considering this cap then on export licenses for this technology, interestingly, with a view to restricting some of this tech to the Middle East, the UAE and Saudi Arabia. So you can imagine there may be some tough diplomatic conversations that will be following on the back of this news. Again, it's a reminder, the Biden administration is trying to tie this thread, and it's a complicated thread on the supply chains around AI accelerators that are needed for these data centers to train these models to ensure that it doesn't get into the wrong hands. There's this big push around sovereignty. We know they've taken steps around trying to restrict China from some of these AI chips. Part of it is that story as well, trying to ensure that China isn't getting these AI chips from other trading partners. So that could also be part of the ploy. The risk that some have flagged is maybe the US ends up losing out market share if the likes of NVIDIA can't get exposure to some of these markets. Now, the Middle East will still be able to buy these chips, but there are these licenses. They'll have to go through that approval process. And again, the Biden administration hasn't yet confirmed these details, but it looks like they're heading in that direction according to this reporting.
Yeah, and just to look at the equity prices, AMD down 1%, NVIDIA less than 1%. How much does it even move the bar for NVIDIA and enthusiasm around it, Tom, when there's just so much demand?
Absolutely, and we've had a reminder that they cannot meet the demand out there. Morgan Stanley, the analysts were on the ground at NVIDIA last week. They put a note out on this, and they said that they're seeing that ramp up in production for the latest chip, the Blackwell chip by NVIDIA, and that demand, they're already pre-booked 12 months out, and according to those Morgan Stanley analysts, they have transparency going out at least another 12 months. So the demand is there. It makes the supply chains more complicated, but the desire for these hyperscalers and sovereign nations to get their hold on these chips seems to be unabated for now.
Tom, we really appreciate it. Bloomberg Daybreak Europe anchor Tom McKenzie there in London. Okay, coming up, we're going to catch up with RBC's Amy Wu Silverman. She points out a shift in sentiment in this options market. We'll explain that for you next, coming up on your Bloomberg Brief.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have been optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Oil slump, crude drops for a third day on speculation that Israel will not strike energy sites in Iran. And it's another record. Stocks notch their 46th all-time high of the year. NVIDIA posts its first record since June. And bank earnings continue. Bank of America, Goldman Sachs, Citi, all on deck. The equity market this morning is slightly weaker. Does it have to do with tech this morning of the U.S. looking at more chip curbs? NASDAQ 100 down about 0.1%. NVIDIA down 1%. Russell 2000, S&P little changed, but Global Fund Manager survey showing the highest adding to allocation since 2020. Bonds, meanwhile, not a lot of movement after yesterday's holiday curve, mostly lower for the most part. Maybe that's driven by oil. Over the past 2 days, oil down 6.3%. With this session and last, those reductions of perceptions of escalation and risk in the Middle East. Washington Post reporting that Netanyahu has agreed to limit its retaliation to military targets versus oil or nuclear facilities. Now, despite those geopolitical risks, a U.S. election in less than a month, a fog of confusing data, investors are approaching this market with unbridled optimism. I mentioned this. Bank of America's latest fund manager survey shows that there was the biggest jump in equity allocation over the past month since June of 2020. Cash positions fell, which analyst Michael Hartnett says triggers a sell signal for the bank. Joining us now is Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. Amy, great to see you this morning. Thanks for getting up early for us. So the cash equity market, unbridled optimism. Is something else happening in this options market?
Good morning. And it is, Danny. It's interesting because we've been talking about the tails getting fatter. And look, I'm a derivative strategist, so I guess I like to live in the tails. And that's an important data point for me because it means that although we're continuing to see all-time highs in the stock market, investors are more focused on hedging. You see that pickup in demand, and that's why you see those tails getting fatter. And I think it means, you know, one, it could just be we're well positioned and we have something to protect, or two, we do see a series of events that could be quite volatile on the horizon, and we are a little bit concerned about what that downside could spell for the equity markets ahead.
How sensitive is it to things like the oil price, Amy? I just asked because oil is falling quite remarkably this morning. Usually this time in the morning, you don't see that big of moves, down 4% for Brent crude at this moment. How correlated are pricing in more tail risk to something like higher oil prices on geopolitical risk?
It's incredibly sensitive. And now I'll just give you one nuance. What we're seeing in terms of hedging is historic call volume, but it's not in the S&P 500. It's in all the energy ETF proxies, because one thing we've learned is when you have a stock market that's so heavily weighted to your NVIDIAs and your Apples and your Amazons and what have you, and energy is such a small proportion, you don't really see that bleed into the market, quote unquote, which is the S&P 500. So you have to go to more direct plays. We see energy investors buying XEG, OIH, XLE, those type of ETF upsides that could be triggered if there's more geopolitical risk.
That's really interesting. So Amy, just overall on a sort of the bearish gauge, in terms of overall individual stocks, are we still mostly optimistic on those index options? Or are you saying that's also where you're starting to see some of that more bearish hedging come in?
So it's a great question, and we're actually starting to see more hedging come in on that index level as well. It's just not necessarily for something as specific as energy. There's obviously different outlets for that. But even on the S&P 500 level, where the first 6 months of the year incredibly muted, I'm talking kind of tails at historic lows, even that is picking up, even though we have that concentration risk at the top. And to me, that's very telling about a shift in sentiment that essentially happened starting August 5th when we got that volatility spike. And it really never recovered in our markets. It's continued to shift more and more bearishly.
How does that set us up for this earnings season, Amy? An earnings season where it's been noted many times that the bar is low, something like under 5% year-over-year gains for earnings expected.
Yeah, I think this earnings season is critical. And typically when you think about volatility, the first few weeks of earnings are when you get the most new information. That tends to be a good time to own volatility. Most investors are approaching earnings season very idiosyncratically, which shouldn't be surprising. So we're seeing more individual stock by stock hedges, and you see that pickup in put skew. So again, that demand and downside hedging for something like NVIDIA, as these names start to come up, we'll see more investors place those demands either for upside or downside. But again, it's shifting more bearishly, even on something like financials. And we're starting to see people play those as those earnings come up.
Interesting. Financials, even after Friday, Amy, I mean, has there been a shift? Really strong earnings from JP Morgan again, after the bar had been set kind of low for them?
Yeah, and the difficult thing is when we see this happening, the question is why? One, it could be a reaction to being long the stock position, right? So sometimes it's more innocuous, meaning we're long the stock and we're just simply protecting any downside scenario. We're not necessarily expressing it outright. What we do see sometimes is when that skew gets very, very high in magnitude, it might mean something else. We're not at that level yet, but I think as we get knee deep into earnings, you're going to get a clear picture of those volatility jumps.
In terms of event risk, Amy, we've been talking about the geopolitics, about oil falling 5% this morning, but there's another clear one, and you've pointed this out before, that the VIX does capture the election. But what about pricing after the election date? How set up for this market is something that might look like a contested election where we don't know the results right away?
Look, that's what I'm worried about, and I think that's what a lot of investors are worried about when you start to see these hairline margins on the polls, when you start to think about what recounts could look like. There's this election day hump, if you will, in the VIX, which is essentially telling you the market is worried about the event itself. But when you think about November 5th, which is U.S. elections, and then November 7th, which is actually the next Fed meeting, that entire week could spell a lot of volatility, and it could also drift into the following week. I've had a lot of pushback with clients on this. Some think this is a sell the news event. And to me, the one worry that continues to linger in my mind is, well, but what if we get sort of a 2000 style contested election where simply we just don't know who the winner is for quite a long time? I think that can sustain volatility. And if we think about that scenario, then really that volatility pricing could remain elevated even past that election week itself.
So what are you recommending clients to do to gear up for that, Amy?
Yeah, look, investors have loved to buy just the absolute shortest tenors they can. You see this perk up in zero-day expiry trading. I would say think about owning a little bit of a longer tenor this time. Yes, I know it costs a little bit more, but perhaps in this particular instance, it's probably worth it. VIX call spreads or S&P puts are a simple way to be protected for this kind of event risk, which could be very drawn out, and we simply don't know until we get into the event itself.
Amy, really wonderful to get your thoughts this morning. There is a whole heck of a lot going on. Walking through all of it with Amy Wu Silverman of RBC Capital Markets. We've been mentioning the jump in oil prices this morning. Let's just get another look. Going as high as 5%, slightly backing off of that for NYMEX crude. Brent crude down 4.8%. European nat gas, that's also tumbling 3.5%. Again, all of this stems from a Washington Post report late yesterday that Israel would be targeting military sites in Iran, not oil or necessarily nuclear sites. So that's some of that geopolitical risk premium being priced out. Just adding to that, the IEA out with a report this morning saying that even with the geopolitical risk, supplies are so abundant that it outweighs it. NYMEX crude, again, down nearly 5% at $70 a barrel. Okay, coming up, we count down to the big bank earnings. We have 3 more big ones on deck today. Opima CEO Octavio Morenzi is going to join us on what he expects on your Bloomberg Brief.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's your Bloomberg Brief. Danny Berger here in New York. So we are counting down to the U.S. election, now exactly 3 weeks away. Candidates Donald Trump and Kamala Harris rallied voters with their economic plans at the forefront in Pennsylvania.
I had a great relationship with President Xi. We had a deal, and he was perfect on that deal. $50 billion he was going to buy. We were doing numbers like you wouldn't believe for the farmer. But the farmers are very badly hurt. The farmers in this country, we're going to get them straiheled out. We're going to get your prices down.
So under my economic plan, we will bring down the cost of housing and help first-time home buyers, giving them $25,000 for down payment assistance so you can just get your foot in the door.
Joining us now is Bloomberg senior Washington correspondent Saleha Mohsen. Saleha, even though they've both been on the campaign trail so far over the past week or so, The headlines have been dominated by Trump, by different things he said, about dance parties, about people fainting. How do we understand the momentum that Kamala Harris once had and whether it's still there?
Yeah, you know, she started to, we saw in August and September was a little bit of the honeymoon phase of a new person on the Democratic ticket, that kind of settling in. And initial polls, it was kind of a little bit of a sugar high. Now that people's reactions are settling down, we're starting to see and hear more information from Kamala Harris, how she is similar to Biden, how she is different to Biden, how she is reacting to Trump. We're seeing polls settle down and Trump gain some momentum as the pair are making their closing arguments now.
I feel like we should just play some of Trump's rally yesterday just because of how odd and remarkable it was. So he turned his rally into an impromptu dance party after it came to a premature end due to some audience members fainting. Take a listen.
The number one issue this country has put on Pavarotti singing Ave Maria. Nice and loud. Turn it up. Let's not do any more questions. Let's just listen to music.
I'm not sure how much more we can add to that, Saleha, but just in terms of Trump's campaign tactic. He was in Pennsylvania there, a swing state, maybe more dance party than substance. But he also was in Coachella. He is also going to Madison Square Garden, doing events in Colorado. Why is former President Trump campaigning in not swing states, in places that are very solidly blue? What is the thinking behind that?
One theory is that he feels, him and his campaign, they feel really confident or pretty confident in their chances to win, and now he's going for the popular vote. He's never won the popular vote. The Electoral College win is how he got into office in 2016. And if their internal polling is so good that he thinks that he can spend time in states that have a lot of Democratic support for Harris, where the Electoral College is what's defining whether it's red or blue, then maybe he's just trying to really win on every level possible. I mean, if you look at the way he handled the rally, he's always been the kind of politician who just pays attention to what is happening in his support group, right? So someone fainted, the situation needs to change. The crowd is restless. Okay, let's turn music on. Let's get the doors open. Let's just change the situation rather than just sticking to the plan. He knows how to connect with his voters.
Now, over in Seattle, just elsewhere in what Washington is dealing with, U.S. Acting Labor Secretary Julie Su Saleha met with Boeing and striking union workers, urging them in their bargaining process. In this election year, are these strikes, is it an issue for these candidates? And how much sway does Washington even have at this moment, just again, 3 weeks away into an election?
The labor part of the country, that constituency has been an interesting one. Most labor leaders haven't endorsed a candidate. Kamala Harris tried very, very hard to get key support from labor leaders. What we've seen is a split where leaders tend to want to go toward Kamala Harris or before that Biden, and the actual union members are more supportive of Trump. And perhaps that's behind why leaders have not thrown their support to any one candidate, because there is this split and they do need to represent their own membership. But yes, you're right. There have been a couple of strikes this year. That is the key sector and the key part of the voting population that each candidate is vying for. The U.S. has turned into an economic populist country, and that means keeping union members in the manufacturing sector healthy and happy.
Saleha, thank you so much for joining us this morning from Washington, D.C., Saleha Mohsen. And don't miss our exclusive interview. John Micklethwaite, our editor-in-chief, will be sitting down with the former President Donald Trump, 12 p.m. Eastern Time. A quick check on you for your markets this morning. Equities, for the most part, lower. It is led down by tech. S&P 500 futures flat for the most part, as is the dollar. Got to be honest, not a ton of action in these markets. Bond markets back open after yesterday's holiday, down by about 4 basis points. The real action, that is in oil this morning. WTI down nearly 5%. Brent crude also nearly down 5%. The geopolitical risk premium getting priced out. Perhaps that is what is dragging bond yields lower too. This is Bloomberg.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. The main event will be before the bell. Big bank earnings from Bank of America, Goldman Sachs, and Citi. Again, all before the market open. We're also going to have some retail earnings today, too. Johnson & Johnson, Walgreens, that's before the bell. We'll also get United Airlines after the market close after an ever-so-slight disappointment from Delta last week. Enough to send shares lower, though. And, of course, don't miss Bloomberg's exclusive interview with the former President Trump. That is at 12 p.m. Eastern. Let's look at some individual stocks on the move this morning. AMD and NVIDIA both moving lower by some 1% after Biden administration officials discussed capping sales of advanced AI chips from NVIDIA in other U.S. chip makers. All of that according to Bloomberg sources. I mentioned there, United Airlines also has earnings after the market close. After Delta missed, there is a focus on capacity. And let's get a check on the banks as we head into their earnings just a few hours away. We have Bank of America, Goldman Sachs, Citi, again, this might be a messy quarter with all the restructuring they're doing. Bank of America will be squarely focused on their retail business and how the consumer is doing after JP Morgan and Wells Fargo earnings both showed a solid consumer. Goldman Sachs, for its part, again, some of that will be on earnings. David Solomon setting the bar lower for earnings, saying it might be something like a 10% drop on trading specifically. All of that coming from the Barclays conference, but just across the board for these banks, what we have seen this quarter set the expectations low and beat them. It's that old song and dance. Let me show you what oil is doing this morning. The other big mover. Oil markets down nearly 5%. NYMEX crude exactly 5%, just above $70 a barrel. Brent crude 4.8% lower. This after the Washington Post reporting that Israel would be attacking more likely military sites in Iran, not oil infrastructure, not nuclear infrastructure. So again, oil prices falling a whole lot this morning. Meanwhile, the IEA also saying that there's enough supply to outweigh even those geopolitical risks. Now, the other big concern of this market has been Europe and the economics of Europe. We do have an ECB decision this week, and in particular, it is the automakers that are feeling the squeeze. A lot of it comes from their Chinese competitors. That's led to some guidance downgrades and tough decisions. Stellantis CEO Carlos Tavares caught up with Bloomberg Surveillance yesterday about the industry. Take a listen.
We are leveraging a strategy that is based on two major pillars. There is one pillar with Leapmotor that brings EV technology at the price of ICE, despite the tariffs that you are mentioning, because we can go around the tariffs by manufacturing the cars inside of the bubble. That's one. On the other side, we have a dedicated platform that we call the Smart Car Platform that we are using to bring compact cars to the market, like the new Citroën C3 that we bring to the market at 23,000 euros, which is the core of the market in terms of pure EV, and that price is extremely competitive. It's on par with the Chinese capability. And that kind of offering is also profitable for Stellantis. So not only we have the pillar of Leapmotor, which is very strategic, we also have the internal pillar, which is the smart car platform that we are now using, for example, for the C3 Citroën hatchback, but also for the C-Cross crossover version, and many other models will follow, Fiat models, but also Opel models, and that is going to bring a lot of competitiveness to the market. So what I'm saying is that Stellantis is in a perfect condition to leverage affordability with profitability and zero emission in the near future.
That was Stellantis CEO Carlos Tavares on the company's EV strategy amid competition from China. Just as a reminder for Europe, we're going to get an ECB decision that comes on Thursday. The market pricing in nearly 100% odds that they will cut by 25 basis points. The conversation has been, though, should they go more? Should they go more with the Fed that's already cut by 50, with employment that's weakening? Of course, the ECB doesn't have that dual mandate, but is the labor market enough that the ECB can't feel comfortable in a slower pace of cutting? So again, odds are for Thursday that they will cut by 25 basis points. So as I mentioned, big bank earnings continue. We're going to get Goldman, Bank of America, and Citi before the market open. That's after a strong start by JP Morgan and Wells Fargo on Friday last week. Just take a listen to what JP Morgan CEO Jamie Dimon said on that earnings call.
Quite clear that I think the future could be quite turbulent. Cash is a very valuable asset sometimes in a turbulent world. And you see my friend Warren Buffett, stockpiling cash right now. I mean, people should be a little more thoughtful about how we're trying to navigate in this world and grow for the long term for our company. I prefer to wait. We will be able to deploy it. Our shareholders will be very well served by us waiting.
So for the most part, the consumer is strong. The credit picture is much better than they expected. But, those little signs of maybe some worrying, like Jamie Dimon saying that there's still a desire to hoard cash and at the same time increasing their credit provisions too. There was also a moment on that call where he basically admonished the analysts for focusing on guidance for NII, basically saying next time, let's give them the damn number. That is a direct quote from Jamie Dimon. Even with any of the risks out there, there's still unbridled optimism in this market. I want to take you to the latest global fund manager survey from Bank of America, saying that investors have registered the biggest jump in optimism since 2020. Cash levels at the same time fell to 3.9% from 4.2%. So where is that cash going? Supposedly, it's going into equities. Again, that's over the past month. All of that, they say, is triggering a sell signal. Despite that, the top three tail risks are geopolitics, 33% pointed it to that, 26% say inflation, just 19% say U.S. Recession. Still, the crowded trades, it won't surprise you, it's the same it's been all year. The Mag 7, 43%. Long gold comes in at second at 17%, saying that. Equity markets are weaker this morning. The big move to the downside is oil, down nearly 5%. That is it for your Bloomberg Brief. Surveillance will take it from here.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
There's a lot of potential earnings upside ahead.
The health of the stock market's going to depend on earnings.
You do need to see earnings estimates continue to rise, we think, in order to support the market.
We're going to see solid, but not blockbuster revenue growth in the third quarter.
Earnings need to do a lot more heavy lifting as we turn the corner into 25.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 2-day winning streak on the S&P 500, hitting the ground running to start the week, the 46th all-time high of the year. We're still counting on the S&P 500. Equity futures down by 0.1%. On the Nasdaq 100, we're down by a little more than that. The calendar for earnings looks a little something like this. Later on this hour, we'll hear from Bank of America. Then it's on to Goldman Sachs. Lisa, then it's on to Citi.
And real question here about whether you get the same kind of tone about the consumer remaining strong. I just want to point out, not only was it the 46th record high for the S&P 500 market weight, but it was the 22nd record high for the equal weight. This is a broad-based rally across the board, as it's not just big tech and NVIDIA, but everyone realizing a no landing might be a good thing, and that's what people are seeing in the data.
Bank of America Global Fund Manager Survey just drops. Bull charge, the biggest jump in investor optimism since June 2020 on Fed cuts, China stimulus, and Lisa, a soft landing.
So how much of this is predicated on the idea of a Fed being really dovish and cutting rates significantly, or is this basically all news is good news? Because essentially, if you have a no landing, it is a good thing. If you have a soft landing, it's a good thing, and you're not going to get a hard landing. Stop thinking about that, because basically the consumer is strong. That's basically been the tone, even as you've had this incredible bullish tilt, whether it's in the fund manager survey or whether it's just in positioning. What you have seen is a pricing out of as many rate cuts, and it hasn't seemed to matter to equity valuations.
And you get a helping hand in the commodity market this morning. WTI, Brent crude, negative by more than 5%. AMH, welcome back around the table. The Washington Post reporting overnight that maybe those energy assets in Iran might be spared.
Yeah, so potentially the United States, Washington is getting through to Benjamin Netanyahu and what they deem as acceptable when it comes to retaliation. What you see in the commodity market is basically that risk premium that came from the President of the United States about a week and a half ago, when he was maybe a little bit too transparent with reporters, saying that these energy assets were in discussion that Israel could target. Now that risk premium is coming right out of the market. The big development, I think, was over the weekend, what Israel got maybe in return for this, and that was the THAAD missile defense system. There's only 7 that the United States has their hands on, and they're sending one to Israel.
Does it stop here, though? Let's say energy assets are spared this time around. We know that Iran's going to respond to this. They've said they already will. If they respond, won't Israel respond? What's the end? to all of this?
Well, one is potentially a cycle of retaliation. The other is what happened when the Trump administration went after Qasem Soleimani, which is in closed-door negotiations through interlocers. What you had was the Iranians saying, we are going to retaliate, but it's going to be a retaliation in name. We are not going to really try to go after something substantially because we want this to end.
This is a long game, and I think that that's what you're getting at here. Halima Croft saying, even if there is this relief rally or relief sell-off in response to maybe not having a strike immediately on the oil assets, don't think that the threat has completely subsided because of the cycle and because of how hard it is to de-escalate when you've got two enemies that are deeply entrenched against each other.
Breaker 70 on WTI, 69.79. We're down by more than 5%. One piece of the market puzzle we've left out. Bring up the board. We've talked about equities. We've talked about commodities in the bond market. This relationship between fixed income and the commodity market, well established over the past few weeks, Bramo. We're down about 3-4 basis points on a 10-year.
This, to me, is fascinating. We saw a huge spike up at the 5-year break-even rates, the expectation for 5-year inflation. We saw in the University of Michigan survey a real pop-up in terms of the 1-year inflation expectations. All of that fades when oil prices come down, which is kind of amazing because everyone says it's not such a clear line from oil prices to actual inflation and to bond yields. It can be deflationary or even disinflationary, but at a certain point, you have to wonder if that's really been what has been the driving force behind the sell-off in bond yields.
Yield to lower across the curve, 2s out to 30s. Your 30-year yield down by almost 6 basis points. Coming up this hour, we'll catch up with Max Kettner of HSBC as the S&P 500 posts its 46th record high of the year. Bloomberg's Saleha Mohsin as Trump and Harris make their pitch to Pennsylvania, and Ken Leon, the CFRA, as big bank earnings resume on Wall Street. We begin this hour with stocks at all-time highs as earnings season ramps up. Max Kettner of HSBC still bullish. A powerful combination of dovish Fed, China stimulus, low near-term EPS expectations, and subdued sentiment leaves us very bullish on risk assets. We find it incredibly tough to form a bearish narrative from here. Max Kettner joins us right now. Max, you've talked about why you're bullish. Let's talk about where you're bullish. High yield credit, overweight, even with spreads this tight, Max. Why?
Yeah, good morning. I think, look, when you look at Euro high yield credit spreads, actually, they are still, pricing in a bit more premium than the US high yield counterparts. We did close the US high yield overweight that we had really for a long time earlier this month. Overall, however, I don't think, it's an environment where you want to be in risky credit over equities anymore. I think it's particularly, you want to be in equities in particular. Yes, you want to be a bit overweight in emerging market debt and high yield credit in particular, but this is the environment, this is the sort of environment that Lisa was just describing, that is the any news and all of the good news is, or all of the news is good news, and that is particularly favorable for equities and in particular for the US.
This is echoed in the fund manager survey from Bank of America this morning, Max. I went through the line a little bit earlier, but really it sounds like you wrote it. The biggest jump in investor optimism since June 2020 on Fed cuts, China stimulus, and a soft landing. Max, the question you ask in your own research of yourself, that you get asked all the time, what would it take to make you bearish? Is that question alone what makes you bullish?
Not alone, but definitely it's one of them. When we look, for example, at our sentiment and positioning indicators, the interesting thing is that actually the bearish and the bullish signals, so the buy and the sell signals, are still pretty much on balance, pretty much the same. So what we're seeing is that sentiment overall is still pretty neutral. So I think, at least when we speak to investors, sort of the overall backdrop is investors are pretty constructive, they're pretty positive, but I think overall there's still a bit of caution going into the election, going into, you've got geopolitical uncertainty, you don't really know around the labor market. Fine, we had one good print around the labor market, but is it really out of the woods? So there's a few questions around the cracks in the labor market as well, around the strength in the US economy, and that keeps investors in a really weird position where they keep telling us, yeah, we're kind of constructive, but at least, in the near term, a bit more cautious. And that is reflected in our sentiment and positioning indicators in the last couple of weeks. Throughout that, actually, we had them closer to a buy signal, despite equities at an all-time high, than closer to a sell signal. And that alone is really part of the reason why we're so constructive and so bullish.
Max, there was a time when no landing was thought to be negative for stocks, because essentially what that would mean would be inflation that didn't come down and bond yields that remained high. Why is that no longer a concern?
I think it will be a concern again when it's properly no landing, when we really start talking about, hey, can the Fed not cut at all anymore, or may they even have to reverse course, and may they even have to hike again? Let's remember that was the case what we had in 2022 when, you know, all of a sudden in all of these episodes, there was way more rate hikes being priced in, and that was the time when credit spreads suffered, when equities suffered, where pretty much everything sold off. We had the same environment in September, October last year, again, where we had Jackson Hole saying it's higher for longer, we can't cut rates at all. We had the same environment in March, April this year, when the rates market was starting to price a possibility of rate hikes. Once that comes back, and once that is really properly coming back into the pricing, then it will become a problem for valuations across all the risky assets. But let's be honest, right now, we're so far away from that, right? We've gone from sort of 9, 10 cuts by the end of next year, we've gone to 6 cuts. So what? That's just a reflection of good growth, good earnings growth, good profitability, good GDP growth, and we'll take it, right? And only once really we're going to see sort of a 180-degree shift, the Fed not even saying pausing, but we're done, that would be a problem, I think, for risk assets.
So is that, just to put a bow under this, how much are you basically saying that if the Fed were to come out and say that they were only going to cut by 25 basis points this year and only had a few more before they might reach neutral, that could be a catalyst, or it really has to be something more definitive where you start to see inflation re-accelerate in a material way?
No, I think it would have to be something more definitive, and it would, to put it a bit more precise, I think it would have been, or it would need a really 180-degree shift from what Powell said during Jackson Hole. Remember, Jackson Hole 2 years ago was saying, you know, he was saying there will be pain for households and businesses. That's what we need. That is what is required to bring inflation down. Last year in Jackson Hole, it was all about higher for longer. This year, it was all about we don't like more pain, we don't seek more pain, we don't welcome it, we'll act against it. So it's literally bringing in the Fed put again. And let's remember that's a way, way different level of rates compared to the 2010s. They've got an awful lot of room to cut. So if, say, for example, one of the next 2-3 payroll data actually do come below expectations, they have a lot of room to say, fine, now let's, the next time we'll go 50 again, and that can cushion any downside for risk assets. So the Fed put now, I would argue, is much more credible even compared to the 2010s. So it would need a really, really dramatic, much more significant shift to become a problem and start becoming a problem for risk assets.
Max, when you look at the Bank of America Global Fund Manager Survey released this morning, the 3 top tail risks are geopolitics,